Maybe the Mag 7 aren't as dominant as they have been. I don't know that that's a bad thing.
The game's going to continue to change as far as kind of the AI ecosystem is concerned.
The Mag 7 stocks are 34% of the S&P. We're all tied to these 7 stocks, and in particular, we're all tied to NVIDIA.
I do think it's a threat to the expectations that we had coming into this year.
It certainly looks like a fairly tough year for investors. US exceptionalism can persist, probably not to such a significant degree.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Tuesday, following a steep DeepSeek-inspired sell-off in the equity market, looking to bounce on the Nasdaq 100 from the biggest one-day sell-off of the year so far. Nasdaq 100 futures right now positive by 0.6%. The main event yesterday, one single name, NVIDIA. NVIDIA getting absolutely hammered in yesterday's session, down by 17%, a record $593 billion taken off the market cap. This is your very small bounce, Lisa, in comparison to that big sell-off. We're up 5% in the pre-market.
There's still some big real questions that people have about whether we have overplayed how much investment in chips really is necessary to generate some of the large language models that people were talking about could be transformative. It is interesting that this was basically a reversal of everything that we had seen over the past 6 months, which is that big tech sold off. NVIDIA, the former leader, was the big sell-off. Everything else did okay, and that was more interesting that the S&P equal weight was pretty much flat.
Totally unchanged, slightly positive. I saw the same thing. Kind of bizarre that the rest of the equity market was kind of okay, had a decent day. But I think what yesterday really gave us was a decent read on the scale of how much is in the price, not just in the tech players, but elsewhere. Nat gas was down yesterday, not just weather-related. It wasn't just front-month prices, it was longer-dated prices too. Nat gas was down about 8%. Nat gas producers, the likes of EQT, we caught up with them last week, down 10%. Pipeline operators, Kinder Morgan, down by 9%. Utility companies, Constellation Energy, which has had a massive run-up, was down by more than 20% in yesterday's session.
And I think that you framed it well. It highlights how everybody jumped on this narrative that the build-out was basically the more the better, the more money you spent, the more chips you bought, the more energy you invested in, the more you would get those returns. And that is what happened until yesterday. And so now you have the likes of Robert Knott, of Research Affiliates, of Ray Dalio coming out and basically saying, well, it was a bubble. And we basically are seeing that. And it's 2000 all over again. And welcome to the new reality.
It's not a quiet start to 2025. Got to be across a few stories already this morning. And not just this one, also the trade story. Check out the dollar. Let's look at euro dollar. Euro dollar last week had its biggest weekly gain going all the way back to 2023. So that's euro strength and dollar weakness. Reversing some of that on the session today. Euro dollar down to 104.26, negative 0.6%. Trade is back on the agenda in a big way.
It's back on the agenda, and to be honest, I don't think it went anywhere. But yesterday, what the market became very aware of is that potentially this threat of Saturday tariffs is real. Yesterday, Donald Trump was in Miami. He talked about a number of items maybe he'd want to put tariffs on, things like aluminum, copper, steel. And then when asked on Air Force One what he thought about a report in the Financial Times of the newly elected confirmed Treasury Secretary saying maybe we would do 2.5%. This is what the report is saying that Scott Bessent would like to enact when it comes to tariffs. Trump said, no, we would go much bigger than that. And that threat is what is keeping the market on edge.
But it just goes back to something that we talked about in the initial week after Donald Trump was confirmed and inaugurated, which is this is really the guinea pig for all trade policy. The dollar, the currency markets, and how much they can get whipsawed by different competing reports at a time when Trump is saying, I have in mind the amount, but I'm not going to tell you. And by the way, Google has changed the Gulf of Mexico to Gulf of America. You can see that on select programs.
You can see that on select programs in the United States, or you could see both of those being marked if you're international. But what I thought was key in that line you just said, Trump says, I have it in my mind. Jonathan, he has concepts of a plan. The market just doesn't know what they are yet.
Ian Lincoln of BMO put it well yesterday, just in a line. Core uncertainties have yet to be resolved. It's January 28th. Core uncertainties have yet to be resolved. They might not be resolved in the next few weeks either.
Which raises the question, why do people keep trading on this? Why does it elicit such big responses in currency markets when we've already seen with the Colombia tit for tat that essentially it can be used as a negotiating tool that can quickly be unwound? So that's something that I'm watching.
A lot to get through this morning, so let's get to it. Equity futures right now on the S&P up by 0.4%. Coming up this hour, we'll catch up with Peter Tchir of Academy On the AI-fueled sell-off, we'll speak to John Lieber of Eurasia Group as Trump vows much bigger tariffs, and Matt Bryson of Wedbush following Nvidia's record market wipeout. We begin this hour with the Nasdaq 100 coming off its worst day in 6 weeks. DeepSeek's cheap AI model challenging the high valuations of US tech stocks. Peter Tchir of Academy writing, I remain skeptical of some of the cheap AI claims, but this moment could be as important to the markets as the unveiling of ChatGPT. Pete joins us now for more. Pete, good to see you. I want to kick off the programme with a statement from Nvidia in the last 24 hours and get your thoughts on it. DeepSeek's work illustrates how new models can be created, leveraging widely available models and compute that is fully export control compliant. What do you make of that last line? Do you believe it's fully export control compliant?
I think that's going to be the really interesting part. Have they subverted some of the things that they're not supposed to get access to, either directly or indirectly, right? There is compute that you can borrow. Have they figured out ways to access that? Or, and this is probably slightly more scary, have they actually been working on their own chips? And we've talked about this before. You can make smaller nanometer chips without ASML technology. It's just very inefficient. And some of the gains that are coming in chip speeds are actually coming from how they package the semiconductors within a chip and how they stack them. That's a much lower technology requirement. So it will be interesting to see, one, maybe this is all just cold fusion and doesn't really exist. Two, maybe there's some other workarounds, but maybe they've actually been developing something that will be very important from a geopolitical and strategic standpoint for President Trump to deal with.
So I wanted to go there. Basically, what the implications are, what it matters, if this is basically something that really did use export-compliant chips and shows a new innovation in terms of efficiency and scale of what you can do versus a new front on the Cold War of technology between the U.S. and China.
So even if it is export compliant, I don't think many Americans, and certainly American companies, will be using Chinese-based AI, right? They're going to do it here. This is open source, so what we should expect is these efficiencies, if they are true, to rapidly evolve and develop within the U.S., right? It's open source. The U.S. can figure this out. We can develop it. I would not recommend any U.S. corporation, using Chinese AI and giving your data to China. We're all sitting there worried about TikTok. This would be far worse, right? TikTok just catches us scrolling through random stuff. This would actually be, what questions are you asking? What's important to you? That would be way more information. So I would not touch that, whether it's export compliant or not.
I think you actually do get a lot of information, particularly about a certain age group, when you look at TikTok records. I'm just saying, theoretically. I am wondering, though, and you mentioned OpenAI, that this is a similar type of potential development as OpenAI. A lot of people said that OpenAI single-handedly was responsible for the U.S. not falling into recession post-pandemic. Is there a similar transformative moment here where it basically marks the gap between investing in chips and the broadening out of tech use?
Yeah, I think you'd almost have that reversal. Whatever happened after ChatGPT, you really saw the Mag 7, particularly AI stocks, do very well. Now it might come and spread to the rest of the world, right? If AI is now cheaper to access and develops cheaper, why not use it more? Why can't more people get involved? So I think yesterday's response made some sense, right? You saw, even of the Mag 7, Meta and Apple did well because this would potentially reduce their spend. I think this is actually probably really good for the economy, if true, as the efficiencies will get developed here. It's probably less good for some of the AI chip manufacturers, though you saw Intel, right, I think did reasonably well because that wasn't their, if you can make this with more bread and butter. So I think this is really exciting, interesting, and probably my biggest question yesterday was all the energy sell-off related. Is that overdone? I don't see that this being the end of AI, and I have not done the work yet, and we're trying to assess, is this new cheaper version a lot less energy dependent, or is the energy dependency actually going to be about the same or even increase as more people adopt? So I think the energy sell-offs where I'm looking for some opportunities today.
When it comes to other opportunities, Trump yesterday called it a wake-up call on the fact that the United States needs to be laser-focused, similar to this geopolitical race. In that sense, if the U.S. is going to be more laser-focused, he just announced Stargate. He clearly wants to put more money into this with private-public sector partnerships. Is now a time to buy even the chip makers?
I think certainly, yes. I like the more basic ones in particular, but I do think, we are going to see a much broader extension of, the CHIPS Act, where I think that had a lot of strings attached, the environmental issues, a lot of other issues attached to that money. I think Trump's going to go much more all in and say, we need to make chips domestically, right? We need to avoid how many chips are being made in Taiwan, shipped right past China, and we did a little bit, some of the potential black swan events for this year. What happens if China does some sort of embargo around Taiwan? Our chip industry would be crippled because of that. So I think that's a huge focus. It makes a ton of sense, and it's exactly in line with the sort of thing I think President Trump and Musk would like to do. You mentioned the energy piece of this, that maybe you'd look for opportunities today. Let's dig into that. Is it the commodity producers,
the energy infrastructure players? Where would you look first today?
You know, I would not probably touch the commodities themselves necessarily. I do think that, you know, drill, baby, drill, or better yet, refine, baby, refine is going to be the mantra of this administration. We're going to pull more things out of the ground. We're going to process them domestically. Again, it's ridiculous that when we take, you know, oil out of the SPR, we have to ship it overseas to turn it into something useful, like diesel or gasoline. So I don't like that, but I do like the producers. I like anything kind of heavy equipment that part of the logistics and infrastructures these things build out. I think it's going to be good, and I do like the utilities. I'm going to be, you know, a little bit careful and pick around, but I think some of this will do well. I think it'll be a little bit regional. And the one thing we've been eyeing is utilities who will benefit from kind of putting data centers in sparsely, you know, populated areas, right? If you look where Bitcoin mining went, right, they were able to use things that were flaring, and they could put the Bitcoin mining right at the source of the energy. I think you'll see a lot more of that going on because you don't really need a lot of people for the data center. You need the energy.
We're still talking about the enablers. We're still talking about the data centers, the chips, the energy providers, the energy infrastructure players. When do we start to talk about the adopters? Is it time to make that shift that maybe the perceived value might be somewhere else?
Yeah, and I think at some point, right, this should really help U.S. efficiency, so it should be good for the broad markets. I like yesterday, you know, I think it's, you know, Russell 2000 might be too small, but I think the S&P 500 equal weight, that's where the benefit should come. And, you know, some of these innovative companies, right, this was the first time now we've seen, you know, kind of a small startup do something. And we go back to 2020, 2021, when everyone was looking for, you know, the innovators, the disruptors. Maybe we go back to searching for that. Who's going to be out there searching for the efficiencies, and stop looking for just the people with the most amount of cash? Look for who has that opportunity for the real multiples of growth.
We didn't talk about the Fed yesterday. Very little. We didn't talk about the Fed so far. The Fed decision is tomorrow. No one's particularly excited for it. They expect it to be basically no change and not a lot of insight. There was a move, though, in the bond market yesterday on the heels of what we saw in the tech space, which was buy bonds, yields lower, inflation expectations and growth lower. Do you think that that has legs, that that actually is telling us something about what the ramifications of the tech developments are?
So I think it's telling us a little bit about that. I think we're also seeing a lot of chatter that, you know, rent is coming down. That's probably been the last outlier in CPI. So if inflation's easing, and my big question is, what will they be looking at on the jobs front? I think some of the data has been overstating the health of the job market. When I look at the quits rate, which I think is important to me because it's like a crowdsource where people actually decide whether they want to quit or not. When you look at the impact of immigration, I don't think it's a problem because the weekend, you know, the lower paying jobs aren't that robust. So does Powell stick to the official data, in which case he probably doesn't talk about cutting? Or does he hint that maybe the labor market's soft and that puts cuts back on the table? So I think there's that potential, and I think Trump would be all over that.
Equity markets matter to confidence. Deutsche Bank came out with a note yesterday, Lisa, I'm not sure if you saw it, that equity gains likely contributed roughly a percentage point to consumer spending in 2024.
When you have a 401k plan or an investment portfolio and it's doing well, people spend more. That's the reason why OpenAI and this whole boom in tech, some people say single-handedly was responsible for the U.S. avoiding recession.
I'm with Pete, though. There's potentially some good news here. Econ 101, like literally the first class you do at school, is the efficient allocation of scarce resources. If we can demonstrate that we're able to achieve some of these gains without the energy that we thought we'd need, I think that's good news, isn't it?
That's basically what everybody was saying, including Sam Altman of OpenAI, basically saying of ChatGPT, saying, we welcome this. It's wonderful to have a robust competitor. So, yes, that's the reason why the equal weights performance yesterday was so instructive for so many people.
It's also why President Trump said yesterday it was positive. It's positive that we can do this on a cheaper front and it can be more efficient. I'm just so curious when this actually starts to seep through to the real economy.
Pete, final word?
Two things, I think. One is they underestimate probably the impact of cryptocurrencies on spending. Crypto's been on a tear. I think people underestimate the political influence it has, but I think it's helped spending, so I keep a close eye on that. And then I do not think the sellover is necessarily done. What scares me yesterday is NVIDIA L, the double-levered ETF, had record inflows. So people were buying that dip yesterday. So I think, yes, we'll bounce a little bit today. It's natural, but I don't think we've seen a washout by any stretch of the imagination. So as this settles in, I think there's more downside, and I kind of watch those leveraged ETFs because they're horrible investments due to how they trade. I do not think the SEC should have approved them because basically the rebalancing causes a drift and you will lose money in those over time relative to the performance of the underlying stock. If you want and own NVIDIA leverage, open a margin account and do it properly. Don't buy these crazy things that have the daily leverage. But yesterday, clearly, record inflows, that tells me the froth is still there.
Tell us what you really think, Pete. Good to see you. Tchir of Academy Securities. If you are just joining us, welcome to the programme. Equities bouncing back just a touch. We're up by 0.4% on the S&P. With an update on stories elsewhere, here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. President Donald Trump said that he wants to enact across-the-board tariffs that are much bigger than the 2.5% reportedly suggested by his Treasury Secretary Scott Bessent. Speaking to reporters aboard Air Force One last night, Trump said, "I have it in my mind what it's going to be, but I won't yet be setting it, but it will be enough to protect our country." The president pledged tariffs on sectors including semis, pharma, steel, copper, and aluminum. President Trump is also preparing an executive order for a next-generation defense shield to protect the U.S. against ballistic missiles and other long-range attacks. The order will commission a system similar to Israel's so-called Iron Dome. The White House says attack by ballistic cruise and hypersonic missiles is a catastrophic threat facing the United States. And the world's 500 richest people lost a combined $108 billion on Monday due to that tech-led sell-off. Billionaires tied to AI, including NVIDIA CEO Jensen Huang and Oracle co-founder Larry Ellison, were the biggest losers, with losses totaling $94 billion. Huang on his own saw his fortune fall by $20 billion. That's a 20% drop. And that's your Bloomberg Brief. John.
Danny, thank you. Got a song to play.
Oh, yeah, on my violin.
And a really, really small one.
Look, no one's going to cry, but at the same time, the magnitude of the declines are pretty impressive.
They're getting richer today. Stocks are back. Up next on the programme, tariff threats back on the agenda.
And remember, again, the word tariff. We're going to protect our people and our businesses, and we're going to protect our country with tariffs. And we're going to look at pharmaceuticals, drugs. We're going to look at chips, semiconductors, and we're going to look at steel.
That conversation up next, live from New York City this morning. Good morning. Equities bouncing back on the S&P, up by 0.4%. In the bond market, yields a little bit higher, reversing some of yesterday's move, up by 3 basis points. The 10-year 456.47. Under surveillance this morning, tariff threats back on the agenda.
And remember, again, the word tariff. We're going to protect our people and our businesses, and we're going to protect our country with tariffs. Tariffs on steel, aluminum, and copper, and things that we need for our military. We have to bring production back to our country. The incentive is going to be there because they have no tariff whatsoever. And we're going to look at pharmaceuticals, drugs. We're going to look at chips, semiconductors, and we're going to look at steel.
The list gets longer. Here's the latest this morning. President Trump reigniting threats of universal tariffs on a number of key sectors. Trump pushing back on a report in the Financial Times suggesting newly confirmed Treasury Secretary Scott Bessent favoured a 2.5% global tariff rate. The president saying he wants the number to be, quote, much bigger. To discuss, John Lieber of Eurasia Group joins us now for more. So, John, these are the threats. I'll go through the numbers. On Mexico and Canada, 25%. On China, 10%. A warning in there for Europe, the prospect of a universal tariff that's bigger than 2.5%. John, what are you taking more seriously out of everything you've heard over the last month?
I'm taking all these threats both literally and seriously. And I think that you have to look at the behavior of the Trump people so far. They are not afraid of breaking things. The way they've approached the federal bureaucracy and the civil service, the way they've approached foreign aid, and the way they're aggressively approaching countries like Colombia, where over the weekend they basically announced they were going to slap 25 and then 50% tariffs on them overnight. I think that you've got to take all of these quite seriously. It would be surprising to me if they did end up implementing tariffs on Canada and Mexico on February 1, as the president said, but they have laid out a process that they can increase these tariffs by April 1st. And that April 1st deadline is going to be really important to watch because that's the date that we're going to get a number of reports from the United States Trade Representative and really all across the government that lay out Trump's trade agenda and give us clear signals as to which countries he's going to go after and what the tariff rates might be. So the challenge here is you have to take everything he says seriously. And while it does seem unlikely that Canadian oil might be subject to a tariff, you never know with President Trump.
How much is it when it comes to Canada and Mexico that Trump is just trying to bring forward the USMCA renegotiation?
I think a lot of it is that, but he doesn't need to do nearly as much as he's done in order to get there. I mean, the Canadians and the Mexicans have already strongly signaled their intention to renegotiate the deal in a way that's favorable to the U.S. in Mexico that has primarily to do with Chinese goods in the supply chain. They've already responded by signaling their willingness to take deportations out of the U.S. So I do think that, the way Trump has talked about tariffs over the last 2 years and the signals he's sending suggest that he sees values in tariffs above and beyond even their negotiating leverage. And so using them to bring production back to the U.S. and punish these countries is on the table. Not to say it's definitely going to happen, but it is on the table.
The newly confirmed Treasury Secretary Scott Bessent, there's this report in the Financial Times that he is pushing for this gradual increase of tariffs. And it sounds like him because in August, when he joined this program, he talked about that. Xi Jinping, you want to get to 60%? We'll do 2.5% for 24 months when you get and tell us when it starts to bite. Trump said it's going to be much bigger than 2.5%, but he didn't exactly say it won't be gradual. How do you see this team of rivals around him, Howard Lutnick, Peter Navarro, Scott Bessent, Kevin Hassett? How do you see these competing groups win over his favor for what potentially we can actually see if it's February 1st or April 1st?
I think this dynamic is a lot like the first Trump administration, where you had different advisors leaking different stories depending on the day, sending signals as to which direction they would go. But the difference now is that the group of advisors is far more aligned behind the president's vision. So the notable thing about Bessent's comments is that the gradual implementation of a universal tariff is considered the moderate position in this administration. That tells you something. And that, I think, is something that markets need to norm in, that actually these policies are being talked about in a serious way, that tariffs are likely going up, that they're looking at doing them universally, even if it doesn't end up being totally universal at the end of the day. But Bessent's talked about this before. Hassett was associated with the plan to do these gradual tariffs in the past. So obviously they're trying to find a way to do the Trump agenda in the least disruptive way possible. But at the end of the day, this is still the Trump agenda. And I think that's what we're going to get here.
John, when we talk about tariffs, at least the initial conversations, we're talking about Mexico, we're talking about Canada, we're talking about Panama, and we're talking about Denmark. Why are we not talking about China?
Yeah, China's a confusing one right now. And, you look at the Chinese have a lot of leverage to get a deal over President Trump if you think that he does prioritize saving TikTok, which he does. And so I think that that's one of the big signals from the early days of the Trump administration is that they're going to delay a little bit some of this confrontation with China. Trump's trying to make overtures to Xi Jinping. We don't think a deal is possible here. We just don't see the space for the two countries to agree. But it is plausible that the Chinese can string the president along for long enough that the tariff hit ends up being a lot worse than it otherwise might have been. Now, our expectation is that China's eventually going to get whacked here. It hasn't happened yet, but it doesn't mean it won't happen. And after that April 1st deadline, I think we're going to see a lot more aggressive trade action against the Chinese.
Hey, John, appreciate your view, as always, taking everything both seriously and potentially literally as well. John Lieber there of Eurasia Group. Part of the reason we had that big sell-off, I would say the reason we had that big sell-off in the dollar last week, worst week against the euro going back to 23, was because in the first week of the Trump presidency, we didn't get tariffs. A lot of people trying to read between the lines and maybe reading into this too much.
Well, especially because the conversations have been closer to home, at least initially. They've been about Mexico and Canada. Canada saying, why are we getting targeted? Mexico saying, are you kidding, with Gulf of America? And then really people are wondering, what's the real front? Is it going to China? Is it going to Europe? And it's the reason why, again, it's sort of surprising how big some of these moves are.
I would say two things. We didn't get the exact tariffs he was promising on the campaign trail, but we did get a review of wanting to look at the trade negotiations the U.S. has with partners by April 1st, which means this team needs to come up with a plan. Trump is basically saying he has concepts of what he wants to do, but doesn't have it yet. But also, he doesn't have his team fully through the door. Last night, Scott Bessent got confirmed. That's the Treasury Secretary. We're still waiting for his Commerce Secretary. We're still waiting for Jamieson Greer to get there. So he still needs these are all the men in the room to decide what they're going to do on their tariff plan. Doesn't have that yet.
We're only 2 weeks into this. If you are just joining us, welcome to the programme. Nvidia in the pre-market up by a little more than 5%. Equities are bouncing back just a touch. Up next on the programme, Matt Bryson of Wedbush following Nvidia's record market cap wipeout. Stocks are bouncing back. Equity futures on the S&P up by around about 1/3 of 1% on the S&P 500. On the Nasdaq yesterday, closing lower by more than 3%. The biggest single-day decline of the year so far, bouncing back there as well by 0.5%. If you strip out the muscle of big tech, and Nvidia, of course, makes up about 5% of the market cap weighted S&P 500. As Lisa mentioned earlier, I think a lot of us noticed this yesterday, the equal weight S&P was actually basically unchanged on the session, even though you had that big decline on the market cap weight S&P 500. The single name to watch today, of course, is Nvidia. That bounces back by 5% after the big decline in yesterday's session. A move of $589 billion in market cap, just absolutely unbelievable. And in the bond market, is this a macro event or not, or was that just risk aversion? Certainly in foreign exchange, you saw that risk aversion in the Swiss C and the Japanese yen. We just relaxed some of those moves right now. Yields are higher by 3 basis points on a 10-year, 456.67. That's the cross-asset market action. Let's get you some single name price action too. Numbers from GM. Lisa, General Motors just dropping across the Bloomberg.
Yeah, and it seems to be a beat across the board. Looking at the 2025 adjusted earnings per share forecast, $11 to $12. The estimate had been $10.60 across the board. Whether it's net free cash flow, whether it's net income, that also rising, net sales increasing. The only miss was actually adjusted EBITDA in North America, and that could be tied to actually a charge having to do with some of the removals from China in terms of closing out some of the joint ventures. So it looks like a beat across the board, and I'd be curious to see how the stocks are performing right now.
Including, as you mentioned, on the outlook as well for 25, the range for EPS $11 to $12, the estimate $10.60. You wanted the price action. Stock is up. It raised in this morning's decline. The stock is positive by 3.5%. GM earnings then just crossed in moments ago. Joining us now, I'm pleased to say, is Bloomberg's Craig Trudell. Craig, welcome to the programme, sir. What do you make of these? They look pretty decent on first look.
Yeah, solid numbers, and I think the outlook for this year is, sort of for more of the same. I think there's a sort of Cadillac Escalade size, caveat to all this, which is that their forecasts, they don't take into account the potential risk of tariffs from the Trump administration. And I think that's going to be something that, gets talked about quite a bit with analysts today, is kind of, trying to get arms around, just how much risk there is here. Particularly, I would say, on the tariffs, that Trump has threatened Canada and Mexico with, because that would be really disruptive even to U.S. car makers like GM and Ford. And so that's something that I think, investors are really kind of braced for and maybe, reluctant to dip into these stocks until they are more comfortable with, just how much risk there is there.
Yeah, CFO Paul Jacobson has a tall task as he comes out before this and says, we've been preparing for that. We've got a pretty extensive playbook. There's another risk here, which is the whole idea of autonomous driving and some of the valuations that you're seeing at the likes of Tesla and questions around how General Motors competes at a time where a lot of people says this will be the vanguard. How do you see them discussing that at a time where it still could be a loss center?
Yeah, I mean, I think they took steps late last year to really kind of wave the white flag, I would say. They decided to basically pull the plug on trying to make the robo-taxi business work, which, is pretty remarkable to see, Tesla continue to have, such a valuation premium, despite the fact that they, were quite a bit behind GM's, Cruise unit in terms of actually getting cars onto the road and proving out, the technology. I think GM, managed to make some progress in terms of commercializing that business, getting it to where, they were starting to collect fares. But the problem is that, there's very little sort of forgiveness for mistakes with this technology. When you have a robot in control of a car and something bad happens, in this case, it was another car hitting a pedestrian, and that pedestrian sort of, glancing off another vehicle into a Cruise vehicle. It led to this crisis that ultimately, forced GM Cruise cars off the road, and really was sort of Cruise's undoing. And so they've decided to fold that business into GM and kind of focus more so on driver assistance systems, and really sort of put off the question of robo-taxis. I think betting that this is going to be something that, is going to be a loss center for other companies and going to take, maybe a decade or more to really, reach scale.
Hey, Craig, appreciate the update. Craig Trudell there of Bloomberg on General Motors. Outward numbers just moments ago. Numbers better than expected. The stock is up by about 2.5%. The outlook better than expected. But how much weight can you put on that outlook? This was a note that came from Bernstein back in November. The note came out and it said GM and Stellantis import 55% of trucks sold in the US from Mexico and Canada. How much weight can you put on the outlook where it's a simple tariff change from the President of the United States can upend this whole business?
It's the reason why you haven't seen these shares really perform, even as General Motors in particular has really beat pretty consistently and turned around in performance in a number of different units.
Stock is up by 2.5%. Under surveillance this morning, the one stock to watch, Nvidia recovering after its worst day since March 2020. The stock wiping out almost $600 billion in market cap, the biggest single-day drop ever for a US company. The move coming after DeepSeek's cheap AI model fueled concern over US tech dominance.
So Jim Reed over at Deutsche Bank compared the drop in market value as being more than the total market cap of ExxonMobil and MasterCard. You can basically put most companies into that bucket that the one-day drop in valuation is commensurate or superior, surpassing in some capacity. What does this say? Number one, it says how high valuations had gotten. And B, it talks about consensus trades, which is the reason why you're hearing a lot about bubbles and 2000-like behavior and all sorts of studies. I expect the histrionics to maybe die down, but there has been a mentality shift, and it seems like it may not go away so quickly.
The president weighed in yesterday as well. Donald Trump addressing concerns about DeepSeek, calling the Chinese startup's progress in AI a positive. Trump also delivering a warning, saying the company's apparent breakthrough should be a wake-up call for U.S. companies.
He basically wants U.S. companies to be laser focused on this. He says we should be out in front of China. He even said Chinese officials have told him himself that the U.S. has the best scientists. Also, weighing in on this was the new AI crypto czar within the administration. That's David Sachs. He went on Twitter, and he was talking about how Trump was right to rescind the Biden executive order, which he says hamstrung American AI companies without asking whether China would do the same. He said, obviously not, and I'm confident in the U.S., and then we cannot be complacent. This goes back to Trump's push last week ahead of all of this with Stargate, but how much more money and how much more effort is really going to go towards this?
We'll catch up with Bernstein later. They put out a great note yesterday. They said, we believe that 1, DeepSeek did not build OpenAI for $5 million. 2, the models look fantastic, but we don't think they are miracles. And 3, the resulting Twitterverse panic over the weekend seems overblown.
Basically, it doesn't change the whole model, and that's the reason why you see the little bit of a bounce today. Nonetheless, there has been a sort of denial of the shift away from just investing in a lot of chips to the broadening out. This may open up that discussion a little bit more.
You'll notice elsewhere some dollar strength. Just want to squeeze in this story. Here's the why. President Trump also saying he wants to enact across-the-board tariffs that are, quote, much bigger than 2.5%. His comments coming after the Financial Times reported Treasury Secretary Scott Bessent is backing universal tariffs on U.S. imports starting at 2.5% and then maybe rising over time. The main event, though, stocks are raising some of yesterday's losses after Chinese AI startup DeepSeek sparked a $1 trillion rout in the US tech stocks. Matt Bryson of Wedbush writing, the AI race is still more about being the first to create models that realize greater value from AI versus lowering cost. And software efficiency yields historically have led to more hardware spending and not less, because the ROI of investing in hardware only increases. Matt, I'm pleased to say, joins us right now for more. Matt, welcome to the programme. I shared a quote from NVIDIA a little bit earlier this morning. I'd like to read it again and get your thoughts on it. When they say that DeepSeek's work illustrates how new models can be created, leveraging widely available models and compute that is fully export control compliant, do you believe what you have seen is fully export control compliant?
I mean, it's really hard for me sitting here in Boston to say what resources DeepSeek used. Obviously, we've all seen the speculation that they had processors that weren't export compliant, that they were using processors that they had before the export restrictions went into place, and that the cost of their model was a whole lot more than $5 million.
That said, Matt, is there sort of a takeaway here that we really have changed the mentality and maybe companies won't be as investing as much in capital expenditures to build out AI because there is an example of how things could be done more efficiently going forward?
So I still stick by what I wrote, which is the question is, or the thought process is AI changes how technology works. And so if you think AI is going to enable a great new technology like autonomous driving, it's not that it's too expensive right now. It's that it doesn't have the capabilities. And so the investment you're putting into your data centers is to enable that technology, and you want to be first to that technology, because we've seen time and time again, when you have leaders in technology, they tend to stay leaders. Microsoft, Google, Amazon, you can go down the list.
That said, Mark Benioff of Salesforce had a great quote. This is kind of classic in our industry. The pioneers are not the ones who end up being the victors. Matt, how much are we learning that some of the biggest gainers so far on the AI craze are not necessarily going to be the big gainers? Was this the Cisco moment for the likes of NVIDIA?
So the question then, I think, is, did we overbuild? So you look back to 2000, did we simply build too much infrastructure like we did back in 2000 and we'll never use it? I guess I would be surprised. I think that the difference is in 2000, we created the backbone. 1999, 1998, we created the backbone of the internet. The internet was working at that point. Again, with AI, we still haven't really realized what the benefits of AI are. So I think until we see, here's a great new chatbot, or here's a great new personal assistant, and I'm buying a new iPhone because it's changing my life with this personal assistant, I think until then, it's really hard to say that we've invested enough.
Well, where do you think we are now in the cycle? Is there a chance that it's overinvested?
I think there's a chance that next technology takes longer to show up. So we get to the end of this year and there isn't a breakthrough in autonomous driving. There isn't a breakthrough in a personal assistant. And so companies look and say, is that goal that we've been shooting for, is it really achievable the way that we're going about it? And people rethink that. And that's been the concern with NVIDIA last year, heading into this year, that at some point you can't justify the investment. But I don't think this changes that goal or the amount that people are willing to invest to get to that goal. Because again, if you create autonomous driving, the returns are amazing. It's kind of, if you became dominant in the search market back in the early 2001 timeframe.
Well, you talk about the fact that in this intermediate term, if it is more efficient AI, like we're seeing from DeepSeek, that on the margins, we could see increased adoption. What does that mean? What does that look like?
Yeah, so if you think about AI, right, part of it is part of the question is the expense. So think about it in search, for instance. I think people have said a search on using AI is something like 10x a traditional Google search. So if all of a sudden I can bring the pricing down by 90%, then maybe I move my infrastructure from traditional search to AI search, and then moving forward beyond that. So I create this new app. Let's say it's again a personal assistant on my phone. If it's easier, if it costs less to support that app from a hardware perspective on my phone, then there'll be quicker adoption. In turn, it leads to a faster refresh cycle, more semiconductors getting sold, and so that's why I'd say in the intermediate term, lowering costs. We've seen it again and again. Server virtualization, for instance, it leads to faster adoption.
Hey Matt, I just want to squeeze this in. Does this not raise questions about valuations of some of these firms, though? Do we have to sort of readdress that just a little bit, even if you can be optimistic about the future?
I think the valuation question is always a fair question, and certainly markets have, particularly recently, fluctuated wildly. But no, again, I think the value of these firms is what we might be able to change in the future, not how much it costs to get there.
Matt, appreciate your time and your input, sir. Thank you. Matt Bryson there of Wedbush. NVIDIA right now positive by 4.5%. Some optimism there. Still a constructive view.
That essentially we haven't really, to his point, we haven't really seen the broadening out. And there is this theory that the more quickly you can broaden out, the more demand, suddenly you have a real valuation, and then it can keep growing, and that's what people are betting on. Of course, there still are people calling it a bubble.
If you had the choice of watching the news conference with Chairman Powell or listening to the call with Microsoft and Meta, what are you choosing?
Obviously, Jay Powell. Just kidding.
Microsoft and
not.
Meta.
Without a doubt, right? Without a doubt.
Kidding.
It's got to be. It's got to be. That's must watch tomorrow.
I actually am curious about what Jay Powell's response is to some of these AI developments and how much that shifts their thinking about efficiency. How are they modeling out something that the market is saying is going to be transformative to the employment market and beyond at a time where they've been flipping and flopping?
That's why we've got special programming for you tomorrow on the Federal Reserve at 1:30 Eastern Time. It's a good try. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Scott Bessent has been confirmed as the next U.S. Treasury Secretary, winning a Senate vote 68-29. That includes support from 15 Democrats. The former hedge fund manager's policy objectives include 3% GDP growth and a 3 million barrel per day increase in U.S. oil production. Israeli Prime Minister Benjamin Netanyahu is planning to visit Washington next week to meet with President Trump. People familiar say Netanyahu wants to speak with Trump about maintaining the ceasefire in Gaza. Israeli media is reporting that Trump's Middle East envoy, Steve Witkoff, is expected to travel to Israel this week to discuss longer-term solutions to regional conflicts. GM shares, those are rising just about 0.7% in the pre-market. The U.S. automaker reported better than expected fourth quarter earnings. It also offered a profit outlook that topped Wall Street estimates thanks to improvement in the Chinese market. Its upbeat forecast, however, does not account for potential tariffs on Canada and Mexico. The company, though, assured investors that it has a, quote, playbook for that scenario. And that's your brief, John.
I'd love to know what that playbook looks like. Danny, thank you. What is that playbook if you come out with 25% tariffs on Mexico and Canada?
Run, hide,
right?
Cry.
Yeah.
Maybe move.
Unless it's a carve out.
Hopefully they reveal some of that playbook for us. Up next on the program, U.S. dominance under threat.
We came into 2025, and I think across the board, outlooks, the theme was US exceptionalism. We're at the end of January, and a lot of this has the potential of already being rewritten for 2025. I think there's a longer term story where US exceptionalism can persist, probably not to such a significant degree.
That conversation up next. You're watching Bloomberg TV. Equity futures on the S&P bouncing back, not by much, only by 1/3 on the S&P 500. In the bond market, yields down across the board, across the curve yesterday. Yields up this morning by 3 basis points. The 10-year back to 456.47. And for those of you following the move in Nvidia off session highs, up by 4.5% so far this morning. Under surveillance this morning, US dominance under threat.
We came into 2025, and I think across the board, outlooks, the theme was US exceptionalism. We're at the end of January, and a lot of this has the potential of already being rewritten for 2025. It does really put bigger question marks around those valuations because it reminds investors that these companies are not completely immune. I think there's a longer term story where US exceptionalism can persist, probably not to such a significant degree. Global diversification has to be even more prominent in portfolios.
So here's the latest. Investors reassessing US AI dominance after Chinese startup DeepSeek's newest AI model triggered a sell-off in global equities. Max Kettner of HSBC saying yesterday was not a game changer, writing, when we look at the S&P 500 breadth, it has been quite positive. The equal-weighted index went up yesterday, not down. We might also see more broadening of the market, not only of the index, but also of the AI theme to enablers and users. Max joins us now for more. Max, welcome to the show, sir. I want to pick up on that last point. We've talked a lot over the last year about chips, about data centers, about energy providers. Do we need to talk a little bit more about who will benefit, the adopters? Is that where you see the trade going now?
Yeah, I think so. I think when we look over the last year, or really year and a half, there was a lot of question marks on the AI theme. And we talked to clients, for example, around the monetization of AI. Who can really make money of that? Well, number one, we have already, and we are already seeing, even on an index level, we're already starting to see, I think, some productivity gains, some efficiency gains. When we look across sectors in the S&P, there's a bunch of sectors already, very, very clearly deploying AI and clearly having some beneficial factors from that. But most importantly, I think we've always had sort of this feeling, okay, it's really NVIDIA or maybe 2-3 behemoths that really make money off this. But how are we going to make money with this on a broader scale? So I don't quite get the reaction from yesterday when people say, oh my goodness, it puts the whole year's exceptionalism case really under threat, because we've been moaning about it for really more than a year that, this is not a broad-based story, and actually across all the names, and it's highly questionable whether anyone can make money of that. Whereas what you're seeing now is, with that, if that really comes to fruition, that it is much, much cheaper, which again is actually still remains a heavy question mark behind that. But if that's a theme, then this is a game changer actually for sort of the broader sectors to put AI to a test and into practice and really get some gains from that. So it should then shift more to the AI enablers that clearly have been lagging the trade over the last 12-15 months.
Max, you sound very optimistic, which is as I would expect, considering that you've been taking a good dose of Goldilocks on steroids. I am wondering, though, you talk about it might be a game changer, but it's not the game changer, and certainly not in a negative way with respect to tech. Tariffs, not a game changer. Immigration, the real game changer is disinflation. How do you separate out this idea of disinflation with growth from these other ideas that are whipsawing markets, whether it's tech advancement or whether it's tariffs?
Look, I think on the tech side, it really remains, or on the AI side specifically, I think it really remains to be seen whether that is that big game changer. And if anything, I think that's probably going to be something that we will see panning out in the next few years, not instantaneously in the next 3-6 months. The same thing is on tariffs. We don't know how that will pan out, if it comes, how it may come. Same thing on immigration, on any kind of really big immigration flows. Well, number one, we've already seen a peak in immigration flows in the second quarter last year, and ever since it's clearly gone down. So that and the inflationary impact on that, whether that is inflationary and how much that's going to be, I think that is much more a story for H2, possibly only for H1 2026, but certainly not for the next 3 to 6 months. Because Lisa, what you were saying, the story now is the disinflationary impact from things like super core inflation, from the underlying inflation measure from the Fed, and some of those insurance components that was sort of artificially inflating those inflation baskets at the beginning of last year. That now perhaps not repeating at least to the same magnitude like we've had it in the first quarter 2024 and first quarter 2023. I think that's the much bigger story, particularly from a timing perspective. So to your question, how do you separate them? I think people are sort of confusing the timelines a bit. What we're discussing about tariffs, immigration, possibly
Max,
also
can I just jump in for a second?
changes.
The president is talking about potentially tariffs as soon as this Saturday, and if not, a review by April 1st. Do you not take him seriously or literally?
No, I think a lot of it might be tactics, right? We've seen that possibly also last Sunday with Colombia, for example. So I don't think I think let's put it that way. I think the number one mistake that we can make, both on a portfolio basis, but even on just a trade by trade basis, is to trade off every single headline day by day, right? Otherwise, Sunday evening we would have said, ooh, really bad on EM currencies, really bad LATAM. And then 12 hours later, you would have said, actually, scrap that. Let's go the entirely opposite direction. I think you're really risking then flip-flopping around in terms of your views and really trade off every single headline rather than really trade the sort of bigger picture, the underlying inflation and growth picture, which again, to me, really is sort of outweighing those kind of headline risks that we're facing in the next 3-4 months.
Hey, Max, good to hear from you. Max Kettner there of HSBC. What did he call it? Goldilocks on steroids?
Yeah, he's taking a good dose of that this morning.
Big time. Up next on the programme, at a second hour of Bloomberg Surveillance, Sarah Hunt of Alpine, Saxon Woods, Ed Mills of Raymond James, Greg Peters of PGIM, and a whole lot more from New York. This is Bloomberg.
The consensus is a little bit too optimistic about growth, a little bit too pessimistic around inflation.
I think we'll see a lot more volatility. That's going to give the Fed more time to pause.
I think that coming into this week, the Fed was already somewhat irrelevant because I think everyone knows that they're not going to cut rates.
They'll hold, and then President Trump will disparage them.
It's very possible that the Fed is going to have to take some of their cuts back this year because inflation is at best stuck at these levels right now.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
If you are just joining us, welcome to the program. The second hour of Bloomberg Surveillance starts right now with a small bounce. Maybe you were looking for more. We're only up by 0.2% on the S&P, on the Nasdaq 100 after yesterday's big sell-off, the biggest of the year so far. The Nasdaq 100 only up by 0.4%. Speaking of big sell-offs, $600 billion of market cap, almost that number lost on Nvidia yesterday, bouncing back by just 4% this morning. And I have to say, the bulls are still bullish on this name. Pick a firm. Cantor, saying we see this as progress, as a positive. Deutsche Bank, cheaper AI is likely to mean more AI. Wedbush, this is another golden buying opportunity and not the time to panic.
The reason why people are panicked is because it challenges the fundamental assumption that has driven so much of this rally, which is that any kind of AI advancement would come on the backs of huge investment in chip operators. And if you really undermine that, you undermine, as Rob Arnott said of Research Affiliates, the buffalo on the plain human beings herd. We do get influenced by the narratives around us. This is how bubbles take shape, and that fear seems to be still pervading the market.
Going back to Dan Ives' note, though, he's talking about in his entire basically history covering tech, he calls this an AI head fake. He says now is this means it's a buying opportunity. And then when you heard from the president yesterday, he was talking about the fact that this just means the U.S. needs to be even more laser focused. So almost maybe it means the United States is going to double down when it comes to investing in this space and wanting to build it out.
Does it upend the CapEx narrative? To get there, you've got to believe that this was fully export control compliant. Nvidia yesterday suggested it was. But when you speak to the analysts, they can't answer that question. They can't answer it. And I think that's one of the most important questions with regard to the moves we've seen in the past 24 hours.
They either can't answer it, or if they try to, they really dispute it. We're speaking with an analyst later this morning. You mentioned this about from Bernstein, Stacy, Rasgon, who basically said, in short, we believe that DeepSeek did not build OpenAI for $5 million. Stop it already. It did take more. Still, there is this feeling that maybe people haven't woken up to the broader adoption story. Is this the beginning of that, which could be a positive for the rest of the S&P 493? And that seems to be what we saw yesterday.
Speaking of export controls and trade and tariffs and all that tension, we've got to talk about it. The dollar is stronger. The euro's weaker. Euro dollar backing down to 104.21. Negative on the session by about 0.7%. Trade is very much on the agenda. I don't think it ever left. I think the president is doubling down in the last 24 hours.
You said it right. It hasn't left. It's just the matter of times that potentially he talks about it and adds a little bit more weight into what he plans to do. There was this report in the Financial Times that the newly confirmed Treasury Secretary Scott Bessent is talking about this gradual approach to tariffs, and Trump said no, it's going to be much bigger than 2.5%. He says in his mind he has the number, but he's not ready to share it yet. I think what the market is trying to figure out is what is the number and when will we see them? Because at one point he was talking about this Saturday, this week, potentially tariffs levied on Canada, Mexico, and China, although in written writing, the EO calls for April 1st.
Honestly, it feels like kind of trying to hold water, and I kind of am trying to figure out exactly why markets are getting whipsawed, and I'm very much looking forward to the tech earnings, because I feel like you can hold on to that more than tariff proposals that keep whipsawing.
Meta and Microsoft, together with Tesla, coming up in the next 24 hours. 3 to watch, that's for sure. Some big earnings calls for those companies. Can they justify that big CapEx spend through the year ahead? I just keep going back to that quote from Google's Sundar Pichai from last summer. The risk here is under-investing and not over-investing. Will we get a challenge to that story over the next week or so? Coming up this hour, we'll catch up with Sarah Hunt of Alpine Saxon Woods, with stocks looking to make a comeback. We'll catch up with Ed Mills of Raymond James as President Trump calls China's DeepSeek a wake-up call, and Pourreza of Guggenheim as doubts creep in about the expansion of AI infrastructure. We begin this hour with stocks steady, looking to bounce back after China's AI firm DeepSeek caused a shake-up in global equity markets, sparking concerns about sky-high tech valuations. Sarah Hunt of Alpine Saxon Woods saying there is an argument to be made that this is a healthy pullback. The projections on power and data center growth were already in question in terms of feasibility. Sarah joins us now for more. Sarah, it's good to see you.
Good morning.
Let's talk about all that energy stuff. Nat gas down yesterday, nat gas producers down yesterday, pipeline operators down yesterday, utility companies down yesterday. Would you jump in today?
So I think that was a little bit overdone, but there was a little bit of creep in terms of valuations in that group anyway. They're never going to get the same valuations as tech, but there was a lot built into, especially on the utility side, how much could happen because of the data centers. They're still going to get built. We still need power. Capacity in this country is constrained. We talk about things like brownouts over the summer and things all the time, regardless of needing the data centers, and the fact that you can't now locate data centers because you don't have the power. So to the extent that there is a possibility that we can use less power, that's not, in reality, I don't think, a bad thing.
A lot of people have made the argument this doesn't challenge the theme, it reinforces it. But do you believe that perceived value migrates elsewhere, beyond just, say, one single name, NVIDIA?
I think the biggest challenge is to NVIDIA because obviously the shortages and the ASPs that they were able to get and everything else was driving a lot of that earnings and a lot of that stock price. So the question is, if I do need less chips, is that going to be a problem for them? I'm not sure that we know that yet. And to the extent that this is one of those, here's a bunch of things that we did without really understanding the back of that and what other language models they were using to help generate some of this, I'm not sure we know whether or not you really need less chips. I don't know that that's clear yet. Right now, we're still building some of those things, and we're not going to change that CapEx tomorrow on a dime because this story came out. So from a short-term perspective, I don't think it changes a lot. The question is from a longer-term perspective, and that CapEx build was part of what's been moving this market.
So I can think of a lot of things that I don't know, a lot of them, and things that I want to know more about. I don't know how much I can really understand what to buy, what's potentially bubble valuations. This is sort of the big debate. Is this just sort of a bump on the road to a greater efficiency and greater adoption, or is this really indicative of bubble-like mentality that's been baked into some of the top-flying AI names? How do you know? At what point will you know?
Well, I think what you saw yesterday, right, with the S&P equal weight doing better than the S&P, obviously, because the tech giants were the ones that were having the problem. I think that shows you that there's some air to come out of that because people have been chasing it like it's going to grow to the sky. It's not going to go to the sky. We know that, but we don't know when that growth stops. And I'm not sure we know any more now than we did before, except that we've taken some of that premium valuation down a little bit. I mean, I look at the pipelines yesterday, and some of those pipelines got hit pretty hard. We like infrastructure on the energy side, but some of that was starting to creep up to valuations that was probably a little high. But I mean, if you look at the overall where the market started this year, valuations were high. So the idea that we can get a pullback in January early in the year is not a bad thing.
So what were you buying and what weren't you buying on the pullback? I think it's interesting that you go to pipelines, but you don't necessarily go to NVIDIA.
Well, so NVIDIA is a question that we just don't know enough about yet. We own some NVIDIA. This is all we know. We've been talking about the and all the time, right? You own the technology stocks and you own other things. You don't go all in on technology because when you have days like this, it becomes somewhat frightful. But you have some in your portfolio. You're not necessarily always equal weight to the market. Sometimes you're underweight the market. And you don't go chasing it until you understand a little better why that just went down and where do you think you're going from here. We're seeing a pop this morning. It's not a huge pop. The market is looking like it's a little bit green, but not crazy green. I think that there's still some time for it to work through. And I don't think we know enough for it to answer that question yet.
This past week, we've challenged aggressively, really aggressively, consensus positioning coming into 2025. Yields lower, not higher. Dollar weaker, not stronger. And then tech starts to collapse as well. What do you make of that more broadly? Just how consensus was set up into 25 and the challenges to it in the early part of this year?
What's been interesting is that sort of starting off every year, we've ended up with a very different story by the end of the year than we did at the beginning of the year. So I think that there is that theme has been happening because stuff on the ground is moving really quickly. And something like this that upends a story for some period of time is part of that moving really quickly. I think we don't really know, just like we don't really know what's going to happen with tariffs. We don't really know where the administration is going to land on this. It makes it very difficult to have a theme that you can absolutely stick to and say, no matter what happens, I'm going to do X, because you don't know.
We've had 1 week of the Trump administration and people have decided that maybe he's not that serious on trade. What would you say to those people?
I think he is serious, but I think that the way he's going to be serious about it is going to be in these loops where it starts off this way, it ends up that way. That's been a lot of what he does about different things that he's trying to do, which is, I'm going to put this crazy thing out there, and then I'm going to bring it back to something that you would have said was crazy, but because the crazier thing was out there, now this seems reasonable, right?
It's unpredictable by design.
Yes.
So,
yes.
But a lot of people in the market really kind of ignore it and say this is just a negotiating tactic. What do you say to them?
It's something is going to come. And it's going to come into sectors that we're not sure exactly how they're going to be affected. And it's going to be things that we're going to have to take into account. But if you end up with something like a 2.5 for most of the things and a this for that, as opposed to 25 or 30%, all of a sudden that becomes really manageable. And everyone goes, oh, that's not so bad, because we were throwing around numbers like 30 or 35 or 50. So I think that there is going to be some effect. We don't know what it's going to be yet. And we just have to be we have to attune ourselves to look for that.
So far, what the president has said, at least yesterday, is he knows in his mind what the number's going to be, and it's going to be more than 2.5%, at least based off this FT report. So taking all that together, do you have a base case, or is that too dangerous?
You have a moving case. It is always a moving feast. You're trying to figure out what's going to happen and what's going to happen 6 months or 12 months down the road. Those stocks react very quickly, like they reacted yesterday to that story. I think that there are going to be places where it's much higher than 2.5%, but the idea that there might be a baseline and then some targeted areas is more easy for people to start to think about and model when we get that information. We don't have that information yet, but we know it's coming.
So there's a lot of unknown. We keep talking about it. I keep explaining how I know very little, and it feels like I'm in a black box where I'm just kind of trying to feel my way around, as I'm sure everybody else does. There was something instructive, though, about what we saw yesterday, which is that bonds acted as the relief mechanism, that they performed as they were supposed to in a downdraft. Is that a roadmap for what's to come, or do you think that that was sort of a one-off knee-jerk response that doesn't really tell us much about the trajectory of this year?
No, I think that was good news, and I think that to the extent that people have started to put bonds back in their portfolio because we have interest rates again, that is also good news. And for the government, that's good news because yields come down a little bit, and then we've got an auction coming up. That's a good thing too. So I think that ballast, it should work that way. And we've had some correlations in the last couple of years that were very unusual. And so to see the correlations start to come back to something that makes a little bit more sense from a historic standpoint is not a bad thing.
From an allocation standpoint, can you rely on that being sort of back to normal for the rest of the year, especially given the uncertainty?
Oh, I'm not sure I know what normal is. And I think in the end, it's always you're looking at what's going to happen next. You're looking at what you think is going on, whether or not this story really takes the wind out of the sails of the equity market or it's a blip. Then you think about where that allocation goes. But I'm not sure that you can cookie cutter anything right now.
Sarah, it's always good to see you. Thanks for your time. Sarah Hunt there of Alpine, Saxon Woods. This move in equities is fading. On the S&P 500, we're only positive by not even 0.1% right now on the S&P. On Nvidia, for those of you tracking that name, we do every single day, of course, that name is only up by 3.5%, Lisa. So this is not much of a bounce, and it's fading by the minute.
We haven't gotten much clarity. I mean, that's Sarah's point. If we don't have much clarity, how can people have the conviction that certainly we're not going to see more of the same, especially given that the washout still has potential legs if there is validity to this?
Nvidia positive by 3.5% in the pre-market. With an update on stories elsewhere, with your Bloomberg Brief, is Danny Berger. Hey, Danny.
Hey, John. UK Prime Minister Keir Starmer says the country's economy is starting to rebound. Speaking with Bloomberg's Francine Lacroix, Starmer said his Labour government is prioritizing growth. Starmer also spoke about a recent phone call with President Donald Trump.
There's a huge amount of trade between our two countries. I think that's to our great advantage. I think that's something that we can build on. And so I was very pleased with the engagement that we've had with President Trump. We'll build on that.
Chancellor of the Exchequer, Rachel Reeves, is due to give a speech tomorrow outlining the government's strategy for growth. And shares of JetBlue getting whipsawed this morning between gains and losses after the company reported fourth quarter earnings. The airline reported a loss per share of 21 cents, beating estimates for a loss of 31 cents. Operating revenue also came in slightly better than forecasts. Now, Google Maps users in the U.S. will soon notice a change. The Gulf of Mexico will be renamed the Gulf of America. The renaming will take place once government official sources are updated to reflect the change ordered by President Donald Trump last week. The Gulf of Mexico will remain in use in Mexican versions of Google Maps. International users will see both names displayed side by side. And that's your brief, John.
Danny, thank you. News that you can really use. I don't hate it.
Well, I checked it today. I was like, when is it going to be renamed?
You wanted to have a look?
It was still Gulf of Mexico.
Did you feel patriotic about it?
No, I think it's hilarious. I mean, not hilarious. I think it's serious.
Up next on the programme, an AI wake-up call.
The release of DeepSeek AI from a Chinese company should be a wake-up call for our industries that we need to be laser-focused on competing to win.
That conversation up next, live from New York City this morning. Good morning. This move is not sticking. We're positive by not even 0.1% on the S&P 500. It's a small bounce. In the bond market, yields still just a little bit higher. Following yesterday's decline, yields up by 2 or 3 basis points, 456 on 10s. And the single name to watch, Nvidia, bouncing back by just 3.5% after a big percentage point and market cap decline in yesterday's session. At the surveillance this morning, an AI wake-up call.
If it's fact and if it's true, and nobody really knows if it is, but I view that as a positive because you'll be doing that too, so you won't be spending as much and you'll get the same result, hopefully. The release of DeepSeek AI from a Chinese company should be a wake-up call for our industries that we need to be laser-focused on competing to win.
So here's the latest this morning. President Donald Trump addressing concerns about DeepSeek after the Chinese company's latest AI model rattled global markets. Ed Mills of Raymond James saying the following: DeepSeek's announcement places a spotlight on the effectiveness of U.S. tech export controls. President Trump ordered a review of export controls on his first day in office. We expect that review and the DeepSeek announcement to be a catalyst for further restrictions in 2025. Ed joins us now for more. Ed, welcome to the programme. Let's go straight of all to that line from you. What further restrictions, what kind of restrictions, additional ones, would you expect?
So, John, in December and January, the Biden administration put out some new rules that will put country-by-country caps on some of the chips that are allowed from NVIDIA to go to those countries, to build up the data centers, to go into those LLMs. My expectation is that those rules could get tightened. There's a lot of questions I've gotten at Raymond James on whether or not Donald Trump was going to overturn those rules. I don't think that's going to happen. And then you look in his administration, you have Marco Rubio, you have Mike Walls, hawkish individuals on China. Do those rules say there's certain semi-cap equipment that could make chips that are less than what NVIDIA can do? Some things that went into DeepSeek. Do we see those chips or that semi-cap equipment not go into China because the U.S. government does not want China to have the ability to make them and build out other models?
When it comes to trade and tariffs, are chips now going to also be used as a chip, a negotiating leverage as well?
Absolutely, Annmarie. And that's something we've been saying, is that the rules that were written by Biden, in many ways, we thought those were things that were written with Donald Trump in mind. To the extent there are country-by-country caps, to be able to have Donald Trump come in and say, all right, do you want that cap to go up? Do you want that cap to go down? What are you going to do for me on trade? When it comes to China, this is going to be front and foremost in a lot of those trade negotiations. Donald Trump wants China to adhere to their phase one trade deal that he inked back in 2020. He's going to add certain kind of restrictions on semi-cap equipment that they also want today on whether or not he decides to put in a tariff or ease up on those tariffs.
But Ed, what do you make of the fact that the hot rhetoric coming out of the Oval Office at the moment has been really about other countries, less so China, more about Canada, Mexico, this weekend, Colombia, and he's sort of been a little bit more reserved when it comes to Beijing?
Annmarie, I think that the kind of things that I hear from folks in and around Donald Trump is just because you didn't hear it day one doesn't mean it's not really important. I do think that he feels as if he has a baseline of tariffs that he put in that were maintained with China that gives him a little bit more flexibility. He's looking to see what he can get from other countries where he has arguably even more leverage than it has with China. So here at Raymond James, we're telling folks, do not sleep on the fact that we could get universal tariffs, plus these country-specific tariffs, plus a trade fight with China. When we survey clients, most of them tell us it's not going to happen. I think that's a mistake.
Why do you think clients in the market are so overboard, basically, one side of the boat when it comes to this is really just negotiating? He's not going to pull the trigger.
I think because they think there is a Trump put on the market, Annmarie. I think there is a view that Donald Trump views the equity markets in particular as a barometer of success. And we've seen a little bit of crying wolf so far. We look at what happened with Colombia, and the takeaway there is if he uses the economic power of the United States, the other country is going to back down. That is probably true in the near term, but as I look through the year, I think by mid-year, we're going to have a whole bunch more tariffs on board that we have not today. And I think then what the market is thinking is once those tariffs are on, that's when Trump, the deal maker, starts. And I think finally, Annmarie, there's other parts of the economic agenda that they think are potentially positive. We're talking about extension of tax cuts, deregulation, more incentives to make things in the United States. So it's a balance, but I do think they underappreciate kind of the tariff risk near term.
As we try to see and have to wait to really understand what the tariff risk looks like, people are trying to understand what the framework is that the Trump administration is using to achieve some of the goals that he's talking about. When it comes to tech dominance, I wonder how you dovetail that with immigration policy. I was looking at a government study that showed that foreign-born workers made up about 20% of the tech workforce in the United States. When you look at advanced degree holders, it's significantly higher. I'm just wondering, are we hearing anything about constructive immigration reform at a time where we are seeing the images of the deportations, the mass deportations that Donald Trump promised?
So, Lisa, you're bringing up the argument that got Vivek Ramaswamy kicked out of Doge. There is a desire among a number of the folks within the tech industry, especially those who are very close to Donald Trump, who say, let's do something about expanding out H-1B visas. As you are dealing with illegal immigration, let's do more on legal immigration. The problem for that is when there was a conversation brought up about expanding H-1B or reforming H-1B, the base of Donald Trump and a number of the elected officials who are in charge of changing immigration policy in Washington, D.C., came out adamantly opposed to that. Is it possible? Maybe. But I think what they're thinking right now is that they're focused on kind of the near-term goals of Donald Trump to say there is an increase in deportation of individuals who are in the country without documents who have committed crimes. I think they would say there's a long way between that and impacting the tech industry, which has relied upon a lot of non-U.S. citizens with high tech degrees to have that U.S. dominance.
This raises an interesting and important point, Ed. Are we learning something about where the gravitational force is going to be for at least the remainder of this year in terms of which voices are going to get most heard in Donald Trump's Oval Office?
It's a combination. I think when we look at emergency powers and executive action, tech is absolutely going to be at or near the forefront. They had a seat at inauguration in front of the cabinet. That was not by accident. But when we look to Capitol Hill, when margins are so small, there will always be individuals who are unwilling to vote for a bill. And so that's where they need to keep that coalition together. They need to pass the Trump agenda with only Republican votes. You can only lose one or two of them. So you're not going to upset the voices on Capitol Hill until that agenda is completed, extending out the Trump tax cuts, getting something on immigration for funding of the wall, getting something on defense spending, getting something on energy permitting reform. That's their priority near term.
Ed Mills, appreciate it, sir. Ed Mills there of Raymond James. Speaking of inauguration and the attendees, did you notice that the TikTok boss was alongside the nominee for Director of National Intelligence, Tulsi Gabbard?
Yeah, I mean, you'd have to think, like, how awkward potentially that conversation might be.
If we're worried about TikTok, shouldn't we be worried about DeepSeek in the last 24 hours? That was the conversation that we had with Peter Tchir of Academy a little bit earlier this morning.
Yeah, which is the reason why I think that you saw some real questions around capacity. Didn't it shut down yesterday? It was the subject of a lot of attacks, and then people are saying no one's going to actually use this. I will just say, you say awkward between TikTok's CEO and Tulsi Gabbard. What if it wasn't? What if it was like, yeah, it's just images going through with kids?
That's what it is? Yeah, maybe. If you are just joining us, you're probably looking for a bounce. You're not getting one. On the S&P, we're up by not even 0.1%. We'll catch up with Shah Pourreza of Guggenheim as China's DeepSeek prompts doubts about US AI infrastructure. Anne-Marie's birthday coming up.
I knew that was happening. You are such a brat. Age of Aquarius.
OK, what's wrong with it being your birthday? What's the problem?
I think it should be celebrated.
Everyone thinks it's your birthday now.
You know,
now
happy birthday.
That.
You should really take some time to enjoy
Happy
your
birthday.
Day.
Happy birthday. Equity futures, it's not her birthday yet. Equity futures on the S&P just about unchanged. we're not getting that bounce. It's not coming through. On the Nasdaq 100, higher by not even 0.1%. We'll get you some single names as well, with 2 hours until the opening bell. Your morning movers with Manus Cranny. Good morning, Manus.
Jonathan, you'll be able to look back in history and go, where were you on the day that $589 billion was wiped off the value of NVIDIA? You were chatting to me. $200 billion bounce back, but will it last? We had Pirimi Wealth this morning with Patrick Armstrong saying the question you now must ask yourself is the margins. How much of the margin dissipation is going to be recalculated here? By the way, he was brave. He's writing 110 put options above this. So he's writing premium. It's overdone. It's too aggressive. You've got to accelerate the timeline to competition and to margins. Right now, you've got a $200 billion bounce back. The energy factor, 97% less energy per query. That was the narrative from DeepSeek yesterday. And this stock was destroyed, down 28%. Jeffrey say some of the assumptions. AI is going to be 75% of the overall U.S. power demand. I'm going to say that again. 75% of the increase in power demand here in the United States of America was theoretically down to AI. Do you adjust that? That nirvana of the data center build-out, the gargantuan estimates, do you need to reappraise those? What will you hear from the hyperscalers this week as they want to maintain their hold on this market? GM, the numbers come across the tape. Strong guidance with a murky EV outlook. That's the view from Dan Ives. He's got a $60 target on this. But the bottom line is the guidance. The guidance from GM is, look, we're going to make between 13.7 to 15.7 for this year. That's up on 2024, but they've not accounted for the risk of tariffs of 25% on Canada, on Mexico. They've got a playbook for tariffs, but you know, what is the big risk here? The risk here is, of course, carve-outs and tariffs. It's like a, you know, the old barbell. Jonathan, good morning.
Good morning. Are you going to wish Annmarie a happy birthday?
Oh, come on.
She'd be lucky if I don't sing happy birthday to her later.
Yes. Let's make that song.
It's not my birthday yet. It's ridiculous.
Getting closer, though, aren't we? Under surveillance this morning, NVIDIA looking to recover after yesterday's 17% plunge sparked by worries over China's DeepSeek. NVIDIA erasing $589 billion from its market cap, the biggest drop in market history, eclipsing a previous record also set by the chip giant.
So at a certain point, this tells us more about how overpositioned people were to NVIDIA being the big winner going forward in perpetuity, regardless of the fact that we eventually were supposed to broaden out. I'm actually more curious to answer some of the questions that we've been asking. How realistic was it that DeepSeek truly was financed by $5 million? Did they use the subpar non-Blackwell chips, or did they use something else? And then number three, how adaptable are some of the U.S. companies to this technology that increases the efficiency on both energy front as well as chip usage?
Well, NVIDIA put out a statement to try to answer at least one of those, saying their work illustrates how models can be created leveraging widely available models and compute that is fully export control compliant. But of course, I think a lot of people are saying, well, this is China. Do we really know what's going on behind the doors? What is going on in terms of where the funding is coming from? Is the CCP just pouring money into things like DeepSeek? In 2 weeks, in 6 months, can we see another version of this? And how are they being built?
If they have done this with a whole lot less and achieved a whole lot more, it's tremendously impressive and it upends a lot of assumptions. And you're going to have a lot of people ask questions about spend this week, CapEx from the big players. This came from Deutsche Bank, just in terms of the numbers. The four leading hyperscalers, Amazon, Microsoft, Alphabet, Meta, expected to surpass around $200 billion in AI CapEx over the course of the past year. Phenomenal numbers.
And most of it has gone to building out some of these data centers and acquiring Blackwell chips on pre-order because they haven't been able to make them fast enough over at NVIDIA. Do they retrench with their spending, or do they redirect it to new efforts that have other beneficiaries? And those are some of the questions that we'll be looking for.
That's the only one headwind, not the only one headwind that we're facing at the moment. Trade a big factor as well this morning. The dollar is a whole lot stronger against the euro, as the president says he wants to implement across-the-board tariffs much bigger than 2.5%. Telling reporters, quote, "I have it in my mind that it's going to be, but I won't be setting it just yet. But it'll be enough to protect our country. One thing we do know, it'll be more than 2.5%.
It'll be more than 2.5%, he said to reporters yesterday when they were asking about this report from the FT that is talking about the fact that Bryson is the one, the new Treasury Secretary, pushing for this kind of system. It had brought me back to the debate where Trump said, I have concepts of a plan, concepts of an idea of how he wants to do this. The Wall Street Journal is saying that momentum is growing for them to levy these tariffs on Canada, Mexico, as soon as Saturday. So a lot of people are wondering, is this administration going to wait for the April 1st review? That was the executive order. Or are they going to maybe match what the president said verbally last week, his first week in office, saying maybe February 1st you'll start to see some of those tariffs? The Wall Street Journal says that's potentially what they're working towards at this moment.
What it highlights to me is just the level of uncertainty that keeps getting implemented at a time where we're wondering what the tariff policies are. There's some pretty big policy changes going on in Washington, D.C., having to do with funding being withdrawn, paused, things with respect to career employees and where they're going to go. And I think right now, how do you decipher the signal from the noise at a time when it's pretty noisy?
Maybe some big deals on the horizon as well. The president also mentioning that Microsoft is in talks to acquire the US arm of TikTok. The tech giant was previously in the running alongside Oracle to acquire the Chinese-owned app back in 2020 when Trump proposed a ban during his first term. What a ride we've had since then.
It seems like Satya Nadella had his seat in Mar-a-Lago that made him more amenable in terms of the tie-up. Interesting that X is no longer necessarily the dominant player here. But this, to me, highlights something that we did hear at Davos from someone who does invest heavily in TikTok, which is they think that a deal will get done and that probably it will stay operational in the United States.
Well, it's interesting you mention that and you say X, because what happens to the fact that our own reporting is saying that China, which has to sign off on this divestment, is saying they would like maybe Elon Musk to be the individual that shepherds this company through. They have mentioned no other individual. What I will say is Trump also said yesterday, I like bidding wars because you make your best deal. So if there's a bidding war, that's a good thing. So I think he's going to allow everyone to call him and allow everyone to throw their name in the ring when it comes to TikTok.
So the Microsoft call is going to be 1/3 on the earnings, 1/3 on DeepSeek and 1/3 on TikTok. I mean, you can mix up the percentages if you want, but they seem to be the three big stories going into the print.
Don't miss that after the bell tomorrow, when no one's going to be talking about the Federal Reserve anymore, even though the decision happened just a couple hours earlier.
A lot of people de-emphasise that Fed decision. We've barely talked about it now for days.
I know, because what are they going to say? What kind of guidance are they going to give?
Isn't that good news for Chairman Powell there?
It could be.
Just that we've lowered the bar for him.
It also raises the question of a surprise, especially at a time where even if he does nothing, he will invoke the ire of the sitting president.
It lowers the bar until the sitting president comes out and says there was just a Fed decision. Why didn't he cut interest rates?
In the news conference, so the journalists can ask the questions, which would be perfect. Great TV. Maybe not perfect for the Federal Reserve, but great TV. If you are just joining us, equity futures positive by around about 0.1%. Let's turn back to DeepSeek's market impact of the last 24 hours. Losses extending beyond AI and chip giants as global investors reassess the sustainability of seemingly endless spending in the sector. AI infrastructure companies, including Constellation Energy and Vistra, taking a hit during yesterday's market turmoil. For more on that, we're joined by Shah Pourreza of Guggenheim. Shah, welcome to the programme, sir. I just want to understand from your perspective how you reacted to the news of not just yesterday, but of the past week or so, and whether it upends your thesis for 2025.
Yeah, well, thanks for having me on. But to be honest, we believe yesterday's reaction in the news over the weekend was certainly a knee-jerk reaction in the utility and power space. One of the things we've been highlighting to investors and clients is that this is some of the strongest power demand environment we have seen in over 20 years of covering the space. The U.S. is essentially decoupling from China. In our view, and we don't quite agree with our competitors, 10 to 13% of power demand today is coming from AI on average. That's nationally. So everywhere you look, the demands for energy and power continue to grow. It's a super cycle. It's structural. So whether you're looking at the domestic manufacturing space, whether you're looking at the onshoring and reshoring of the manufacturing sector, the electrification of the system, Trump's big focus is on energy policy. That's LNG, petrochemicals, chlor-alkali. Anywhere you look, even this energy revival is going to push power demand materially higher. Industrial growth is extremely healthy, and that's the key driver of infrastructure needs.
Yeah.
So we believe yesterday's sell-off was well overdone.
Shar, within your points there, I think there is an interesting nugget, which is something that people have been talking about, which if you had the build-out and the pace of the build-out of AI with the current capacity for the next 5 years, there is no way that the energy infrastructure, even with additions, could support that. Can you give us a sense of just, even if you did reduce the energy demand significantly going forward of AI adoption, how you still would have to increase dramatically some of the energy production in the United States and globally?
Yeah, I mean, I think that's a very fair point you're bringing up. U.S. infrastructure has not kept up with the demand. When you sort of think about electricity consumption for the past 15 years, it's been a decelerating commodity with energy efficiency and demand side management. And then out of nowhere, there's this energy revival, there's this industrial revival, and the infrastructure in the US has not kept up with the demand needs. And this is why many of the utilities, the power companies, the ones that we cover, are building a massive amount of transmission system. They're building generation. We've seen the retirement of coal assets get delayed because of this very tight power supply demand environment. So long and short of it is infrastructure has not kept up with the demands, and we do not believe the news around DeepSeek is going to impact any of those fundamentals.
That said, Shar, I guess that one of the potential headwinds to the entire energy sector is just that commodities are actually getting cheaper. When it comes to oil prices, they've been going down. People are getting more efficient at producing a lot of energy. How do you dovetail that into your optimism at a time where we see the actual commodity prices coming down for a whole host of different reasons?
Well, the commodity coming down is necessarily not a bad thing for the consumer, correct? So one of the arguments is to meet the needs of U.S. infrastructure, small modular reactors, likely not a viable option, large scale nuclear, likely not a viable option. You're not building any more coal plants, offshore wind's having a lot of hindrances. So really what's going to satisfy the needs in the near term as a bridge to another technology is natural gas. So the more the commodity curves come down, the more it becomes economical to build the infrastructure that's needed to meet the power demands. So in our viewpoint, the drop in the commodity, the drop in natural gas, which is deconsolidated from utility spending to begin with, is a very big driver for spending needs, and it's very pro-consumer friendly.
Is there a line in the sand, though, where it's good for the consumer, but it still makes sense for companies to go out, create new utilities to make sure that they can drill and get these products to market without losing money?
Well, I think, the barriers to entry to get into the utility industry, it's one of the most capital intensive industries there is. So there is a barrier to entry to get in there. I think the point we're just trying to bring up is talking to many of these hyperscalers that you kind of mentioned, talking to the utilities, there's a need for speed to market, right? Because as Microsoft told us, specifically on a client call, we're in a race to beat China. We're in a race to beat the 3 to 4 hyperscalers. We are not going to pull back spending, right? So the point is the amount of spending that is happening on U.S. infrastructure, whether it's AI, whether it's on the energy space, whether it's industrial, manufacturing, et cetera, has to be met with a generation source, right? And so there's a lot of money being put into it. I think natural gas is clearly the fuel, the bridge fuel to meet those needs, which is why there's so much investment going into the natural gas space. This is why one of the largest renewable developers in the country, NextEra Energy, did a GE deal to build gas. This is why Constellation Energy, the biggest nuclear operator, acquired Alpine, the biggest gas operator in the country. I think the shifts from decarbonization to resiliency and reliability are starting to take shape, because I agree with you that as you're looking at the demand outlook, the infrastructure has not been able to keep up with it.
Sure. How much excitement is driven by politics? Because, of course, Trump just last week lifted the permitting freeze that we had on LNG applications that were put under the Biden administration.
Yeah, I mean, I think politics is certainly part of it. I think under the Trump administration, we have a viewpoint that it's really good for energy, right? So when you're thinking about carbon rules for natural gas, when you're thinking about pipelines, when you're thinking about the LNG markets, there's clearly going to be a push to drill, and the focus is becoming energy sort of independent. And so part of this is policy, but to be honest, even before the Trump administration took the helm, our viewpoint is the demand picture wasn't going away. There's such a big focus on shifting manufacturing back to the U.S. There's such a big focus around electrification of the system. All that is very much pulls on demand, and that is before even the Trump administration took the helm. Now, post-Trump, it sort of adds a lot of additional drivers to it, which is like what you've highlighted. There's going to be a major ease around the energy infrastructure business, permitting, et cetera. Again, all this that you're highlighting is going to push power demand growth higher. It's going to prompt these utilities to build the infrastructure to meet the needs.
Hey, Shah, appreciate your input and your opinion. Thank you, sir. Shah Pourreza there. of Guggenheim. The latest on some of the energy players, including the likes of Constellation Energy. Constellation last year up by 91%. Yesterday, Lisa hammered, down by close to 21.
It's the whole idea of the unraveling of a thesis that seems to have driven up a lot of utilities in addition to NVIDIA and some of the other AI players. At what point do we get clarity around how to understand valuations in terms of energy needs and how quickly AI will be spread?
Many of these guys aren't throwing the towel in, that's for sure. Equity futures on the S&P positive by a little more than 0.1% with an update on stories elsewhere. With your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. President Trump says that he wants to enact across-the-board tariffs that are, quote, much bigger than 2.5%. Those comments after the FT reported that Treasury Secretary Scott Bessent is backing universal tariffs on U.S. imports starting at 2.5%. The president pledged tariffs on sectors including semis, pharma, steel, copper, and aluminum. Boeing shares are treading water, up 0.4%. They reported its sixth consecutive annual loss. CEO Kelly Ortberg saying that he will set in motion a portfolio overhaul after the company reported a deeply unprofitable quarter. The airline manufacturer noted that the 737 program resumed production in the quarter with plans to gradually increase its production rate. Coca-Cola recalling a range of soft drinks in Europe over higher levels of chemical chlorate. The company's bottling partner said cans and bottles impacted have been distributed in Belgium, the Netherlands, the UK, Germany, France, and Luxembourg since November. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes. Up next on the program, higher for longer.
The 10-year is not priced for a higher for longer, structurally higher for longer inflation. It's still very much priced for kind of a 2% world.
A conversation up next, live from New York City. You're watching Bloomberg TV. Biggest one-day loss of the year on the Nasdaq 100 and not much of a bounce back on the S&P 500. Higher here by 0.1%. Yields declining through yesterday's session. Yields up today by 2 basis points. The 10-year 4.5586. And the surveillance this morning higher for longer.
It's very possible that the Fed is going to have to take some of their cuts back this year because inflation is at best stuck at these levels right now, which means the 10-year is not priced for a higher for longer, structurally higher for longer inflation. It's still very much priced for kind of a 2% world.
Investors turning their attention to the Fed's two-day meeting, which kicks off a little bit later this morning when they wake up in Washington, D.C. Greg Peters of PGIM joins us now for more. It's 7:50.
Oh, the shade.
I'm not being rude.
The shade.
7:50.
Yeah, but they stay out till really late. They don't go to bed at 6.
Greg, welcome to the programme. Isn't throwing shade at the FOMC. Greg, I want to go back to that quote that came from Oksana Aronovitch of JPMorgan, when Oksana said we are still very much priced for a 2% world. Do you agree with that, and should we be?
Yes and no. I mean, there's been a pretty radical shift in pricing of the tails. If you look at kind of the option pricing, you have a 30% probability of a rate hike, this year. That's much higher than where we were before. I think it's a worry, but I think the markets are reasonably priced today. Last year, I couldn't say the same thing when, if you recall, this time last year, rate cuts were all the rage, and investors were pricing in quietly 50 in March of last year. So I think we're much more reasonably priced today. I think the tails are representative of kind of the balance of risks, from an option standpoint. So, yeah, I'm not sure I totally agree with that statement.
There's a 0% chance of any kind of movement whatsoever at the meeting tomorrow that the Fed is currently engaged in. Do you still care about it?
Well, it's still only January, right? And so I think we're all hyped up in the first week, post-election, post-inauguration. And so we have a lot of runway. I think what investors are focused on is that the runway is shortening. And so I'm a little less concerned about that as well. But I'm not expecting much from this meeting just because there's so much in flux. I think that's the challenge for Fed officials. That's the challenge for investors, is that there's so much on the come. There's so much uncertainty, and it's going to be a long road ahead.
Given that, Greg, how do you get an edge How do you have a thesis that you can actually, have any conviction with to say buy longer-term bonds, hand in fist, simply because you do think that inflation is going to come down with a backdrop that is so highly uncertain?
Yeah, I think you have to react to the action, not the rhetoric. I think you have to take a longer-term view. Our longer-term view is that there is value in the bond market. Honestly, I'm somewhat indifferent as to whether bond yields rally or not. I really like the carry component of bonds. I think that's the story. That's what bonds are supposed to provide. I think many forgot that in the zero interest rate world. But you got a preview yesterday, and while I didn't necessarily agree with the price action, what you see is that flight to safety is really beneficial in a balanced portfolio. So what I think bonds provide you, Treasury bonds provide you, is that protective measure. And with valuations as stretched as they are, I think bonds really do their job.
Greg, which piece of the price action did you not agree with?
Well, if you just kind of unpack, yesterday's price action around, AI, AI for the masses, whether you like it coming out of China or not, all else equal, is stimulative from an economic standpoint. So I would have expected real rates, if anything, to move higher, bond yields move higher, but there was just flight to quality mechanism. So, the sell-off was really, really narrow, but the bond market, I think, should have been more reflective of what we saw coming out from a data perspective. We got, reasonably positive data news from, new home sales and Dallas manufacturing, and that was kind of cast aside. So follow the data, I think, is the real message here.
Greg, just to follow up and make it really simple then, you believe that maybe the risk aversion distorted the move in fixed income that we otherwise would have seen? That there's an argument here for higher bond yields off the back of the data?
Yes, exactly. So if you look at the credit markets were unaffected. It was it was literally a non-event. So all the movement was in the Treasury market. And if you just take the data on balance, that suggests all else equal, higher, not lower bond yield. But it was a risk aversion trade that really won the day.
Greg, appreciate it. Thank you, sir. Greg Peters there of PGIM Fixed Income. Interesting final point there on the bond market.
That essentially, if you looked at the data, otherwise you would have had a sell-off with yields higher, and that the risk aversion around the potential sell-off of NVIDIA he sees as being misguided because essentially greater efficiency will lead to greater productivity, which will lead to faster growth, which potentially should send yields higher.
Good news for Chairman Powell tomorrow, no forecasts. Isn't that a good piece of news for them? Got to do a news conference, but no forecasts.
No forecasts, so they don't have to say anything. I do wonder if they're going to give a hint about two-sided risk, of the idea that maybe they could raise rates at some point again. And if that's the case, that would be a pretty big shock to the market.
We'll have that conversation in just a moment. In the third hour of Bloomberg Surveillance, we'll catch up with Tom Kennedy of JPMorgan Private Bank, Stacy Rasgon of Bernstein, Lauren Goodwin of New York Life, and Matt Diczok of Merrill and Bank of America Private Bank. All of that and more coming up next.
Maybe the Mag 7 aren't as dominant as they have been. I don't know that that's a bad thing.
The game's going to continue to change as far as kind of the AI ecosystem is concerned.
The Mag 7 stocks are 34% of the S&P. We're all tied to these 7 stocks, and in particular, we're all tied to NVIDIA.
I do think it's a threat to the expectations that we had coming into this year.
It certainly looks like a fairly tough year for investors. US exceptionalism can persist, probably not to such a significant degree.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The open about 90 minutes away. 2 places to look. Let's start with the equity market. Equity futures bouncing back by just 0.2%, up 0.25% on the Nasdaq 100. A mega sell-off on one single name yesterday, NVIDIA. NVIDIA losing almost $600 billion in market cap in a single session. This morning bouncing back, Lisa, by just 5%.
I want to sit on a point that you made earlier this morning in a question you were asking that I thought was really important, which is a lot of the commonplace narratives going into 2025 were upended yesterday. There was this question around AI dominance and how much it would really be about financing the chip sector. There was a question about how we get runaway growth and inflation that would cause rates to go higher. And there was a question about the dollar and whether it would really strengthen. That, I think, is the biggest takeaway, how fragile some of the consensus positions are at a time where some people are worried about just how concentrated gains have been.
And also at a time when there's still so much political uncertainty. We've been talking about tariffs all morning, but that's because the situation feels very fluid. I mean, the president said it himself. He has the number in his mind, but he's not ready to set it yet. So unless you can read minds, it's very difficult to have a base case or even a timeline on when potentially we could see these tariffs levied at Canada, Mexico, or China.
So universal tariffs were at like 2.5% and above. That's all we kind of know right now. It's not 2.5, it's above. Then individual tariffs is 25, this is the threat, on Mexico and Canada. 10% on China maybe, and Europe. What we've heard from Europe at the moment is that Europe's going to get it too because of the trade surplus. So what that means in practice, I still don't know.
Okay, so Mexico is importing things from China, and that's bad. And it's also the immigration issues. Canada is Canada, and you can beat up on them because they're Canada, evidently, and they're close by. Colombia had to do the immigration. What are these being used for, and how these tariffs are being implemented are not consistent. So that's the reason why it is hard to come to any real conclusions across the board.
No, but we did get more color on actually what the president is thinking yesterday when he was talking to Republican congressmen and women. He was talking about the fact that also he wants to go after aluminum. He wants to go after copper because of the U.S. industrial base. He wants to make sure that we have all of this production in the United States. And then he also talked about the fact that you need tariffs to pay for tax cuts.
One man changed the conversation. Donald Trump. When he came into Washington, D.C., this was not a bipartisan issue. Donald Trump completely changed the conversation on this issue. And I think anyone who's saying, you know, he's not going to go through with some of this stuff, I pour some freezing cold water over those arguments big time. There's many reasons to go at China, a lack of reciprocity at Europe. It's been a protectionist trade bloc for a long, long time. Ask many countries and companies who have tried to deal with Europe and they'll give you a decent opinion on that. And as for Mexico, the southern border is a massive issue and was in the election, and he wants to do something about it.
I think that those are all completely correct takes, especially given the fact that the tariffs that were put on under the Trump era stayed on under the Biden administration. And frankly, there is a lot of bipartisan support for particularly levies on China. That is the reason why people are wondering why Denmark and Panama are in the crosshairs in Canada rather than, focusing on some of the other players.
So Greenland has geostrategic importance, and I think we all understand that. So I agree, it gets confusing when you try and throw everything against it.
I mean, it's like Gulf of America, the Panama Canal, what's going on, Denmark, give us Greenland.
Panama Canal on the margins is about China. It's the fact that China has these ports there. They're controlling the canal. And Greenland is also not just about Canada, but also about Russia and how important the Arctic is to both these countries.
We'll see what the weekend brings. Equities right now on the S&P positive by close to 0.2%. Coming up through the next hour, we'll catch up with Tom Kennedy of JPMorgan as DeepSeek rattles global markets. Stacy Rasgon of Bernstein on why the ensuing panic is likely overblown. And Lauren Goodwin of New York Life on why Goldilocks economy is the Fed's to lose. We begin this hour with stocks looking to recover. Tech bulls getting a brutal wake-up call as China's AI startup DeepSeek calls into question US tech leadership. Tom Kennedy of JPMorgan saying we are moving fast through the AI tech build-out, and volatility in the sector suggests adoption is set to accelerate. The winners, Main Street, big tech and China. The losers, AI infrastructure spending and US exceptionalism. Tom joins us now for more. Tom, good morning.
Good morning.
Certainly saw that play out yesterday. Is that a short to medium term call for you, or something you see playing out over the long term?
I think the big takeaway is that this movement through the AI adoption phase is happening a lot faster than we all thought. If you break it down, AI technology build out in three simple phases. One is proof of concept. OpenAI did that for us a couple years ago. Then we thought we were in this multi-year build out of the infrastructure to support adoption, and DeepSeek accelerates us through that. So now I think the incremental next 3-year look is you got to start to rotate more towards the application phase. And what that exactly looks like still remains to be seen, and we're experimenting and figuring out. VC community is very focused on robotics, but there's more to do. And from an investing perspective, that middle phase, shorter than we thought.
So from enablers to adopters, is there a preferential sector, a preference right now on a sector basis for you?
I think in the long way, you're going to get the big broadening out as the first takeaway. That U.S. exceptionalism, you guys talked about it, these really consensus views walking into the year. We were U.S. exceptionalists too, but this is a dent there for sure. So the broadening out to Main Street is a winner. Also potential for Europe. If you're going to get mass AI adoption, you'll get the productivity quickly. But our preferred sectors are still tech, industrials, utilities. This is a real question now. The intensity or the bottleneck in the infrastructure, maybe it eases a little bit, but if we're going to get adoption in AI a lot quicker, volume will really pick up quickly, and you're going to need the infrastructure there too. So we still like those sectors, again, at a price, and you just got a better price at them.
So basically, you're not buying NVIDIA in the dip.
I think what you need, the infrastructure play is more than just chips, is the point. And it starts to circle around other topics you're talking about here too. Infrastructure build out for immigration, infrastructure build out for separation from China, and the picture is more ways to win in an infrastructure build. Still think the chip play is there, just don't think you're there at this moment at this price.
So there was something else you said about U.S. exceptionalism.
Yeah.
Does this mean that you think that the dollar is now going to weaken steadily from here?
No, we don't have a steadily weakening dollar, but the notion that AI innovation and AI exceptionalism in America is going to push the dollar higher, it's unlikely to be there. I think often we don't take the time to what causes AI, what causes U.S. exceptionalism. It is tech innovation. We have the highest earning companies in America. It's immigration. People want to move to America. Trump is trying to do deportation, but over 200 years we've had net immigration to America. Common law system and a world where people are going to inflow capital here. There's many ways the U.S. exceptionalism still works. And in America, the productivity output that we're getting from growth is just unmatched elsewhere.
I just want to understand what you believe about DeepSeek.
Yeah.
And then build on that. Do you believe that it was built for $5-6 million? Do you believe that they did this? And I'll quote NVIDIA directly in their statement that came out yesterday when NVIDIA turned around and said they leverage widely available models and compute that is fully export control compliant. Do you believe that it's fully export control compliant? Because I think what we believe really, I think, shapes your investment thesis beyond that. Because if you believe all that, it upends a lot of things. Do you believe all that?
I don't know what to believe on all of that. How exactly they did things, from what we're told, this was the final leg of the training was done with low cost, older chips, and leveraging prior best-in-class models. Now, the legality of that is not necessarily my concern. But what it does do is open up the opportunity now to scale AI much quicker than we thought. If I don't need the compute power, which was perceived to be a bottleneck, and I don't need the infrastructure, again, another perceived bottleneck, I can accelerate adoption. And that means AI brings to the masses and productivity can pick up. It benefits the players in the space that don't have the capacity to spend big on this.
So productivity picks up. What does that mean for your call on the economy more broadly?
It probably means there's upside skew to our view on growth, and there's downside skew to our view on inflation. All else equal. As we figure this out, though, that's a higher for longer world.
Just quickly then, yeah. That's what I'm thinking about. Do you think there's questions to be asked of Chairman Powell tomorrow?
Yeah. I mean, my two most important questions I'd want to sit there if I'm sitting there in the audience. Are we still meaningfully restrictive? What does that word meaningfully really mean? And can you cut rates in of itself if just inflation cools? Is that sufficient to cause the cuts? Those are the two questions I would ask. And maybe those are the only two questions we're actually going to get fun intelligence tomorrow.
There is this feeling that there could be an opportunity for Jerome Powell to open the chance for two-way risk, to either hike or cut at some point this year. Do you think that would be appropriate, given some of the technological transformation and some of the uncertainties?
No, I think it's quite unlikely he'll do that, is open the door to a hike.
But do you think he should?
No, I don't think he should. Mostly because the labor market is what matters the most in America. And momentum in the labor market is still cooling. Some could argue stabilizing, but it's very hard to argue that the labor market is retightening here, in my opinion. So the most indicators to look at, quits, hires, initial claims as a way for stabilizing and reacceleration. So until you see a tightening there, I don't see any reason to think that hikes are necessary.
Trump is currently, though, carrying out deportations, which could mean a tighter labor market, no?
Biggest risk to this call is that he will change the supply and demand dynamic in the labor market by reducing supply. In his first term, Trump ran on deportation in his first term. His deportation rate was about half that of Obama's. So using history as a guide, I do think there's a big risk here, just low probability that mass deportation changes this.
But if we were to see that, then would you consider potentially a hike has to be on the table?
Without question. I think it's hard to argue that the soft landing would have been possible without the immigration surge. So the opposite of that, Annmarie, would be a risk for sure.
Just going back to the very beginning, you said that yesterday you really did question some of the holdings that you have. Have you taken action on that? What are you waiting for to really decide whether you have to shift some of your views for 2025?
Yeah, I think the things that we talked about, winners and losers here, are Main Street's a winner. These big tech names, though, are not an obvious loser to me. The big tech hyperscalers, your top 5 names, they have access to the software and the interaction with their clients, so volume can actually sustain them. But from a loser perspective, we have to question the infrastructure build out. And it's about chips, it's about power consumption, it's about power generation, it's about water, cooling, land. Like, that's what we're questioning right now.
These moves yesterday, we mentioned a few of them: pipeline operators, gas producers, utility providers. Lisa, they were huge moves in yesterday's session.
And it came off the heels of two things. First, that everyone was believing this story, that there was going to be an infinitive use, a sort of infinite amount of demand for energy and infrastructure as a result of artificial intelligence. But it also speaks to just how high valuations had gotten at a time where there were so many different stories that were converging.
There was a forecast for warmer weather in the mix as well. So I know it's hard to divide the two issues, but to see natural gas down as much as it was yesterday.
You think it's because we're not, 2 degrees Fahrenheit here in New York City?
Yeah, there was a weather element to the move we saw yesterday, particularly at the front month. Yeah, in futures.
Sure.
But further out, the move you could see, that's all about energy use. And I think that just speaks to a part of this being good news. If it's real, it can be very good news.
It could be very good news because you couldn't have the adoption people were talking about with the energy that we had. So this actually is a positive and potentially disinflationary, which is the reason why we hope that Fed Chair Jay Powell addresses the NVIDIA question tomorrow at his Fed conference.
Mike McKee is going to ask questions in the news conference. We'll make it happen. Tom, it's good to see you. Appreciate it. Thank you, sir. Tom Kennedy there of JPMorgan Private Bank. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. It's Danny Berger. Hey, Danny.
Hey, John. Scott Bessent has been confirmed as the next U.S. Treasury Secretary, winning a Senate vote 68-29. That included support from 15 Democrats. The former hedge fund manager's policy objectives include 3% GDP growth and a 3 million barrel per day increase in U.S. oil production. President Trump weighing in on the future of TikTok, saying Microsoft is interested in buying it. Microsoft declined to comment on any involvement in a possible deal. AI startup Perplexity has submitted a bid to merge with TikTok US, while billionaire Frank McCourt, former owner of the LA Dodgers, made a formal offer to buy the company earlier this month. Shares of JetBlue are tumbling 8.4% in the pre-market. It posted a fourth quarter loss per share of 21 cents. That is better than a loss of 31 cents that was estimated, but it was its cost outlook that was higher than expected. They're expecting it to rise 7% in 2025. The results are a setback for JetBlue, which had been focusing on reducing costs and improving flight operations. And that's your brief, John.
Danny, appreciate it. Thank you. More from Danny in about 30 minutes' time. Up next on the programme, the Morning Calls Plus, Stacy Rasgon of Bernstein saying market hysteria over DeepSeek is likely overblown. That conversation up next. Lots to get through as we approach the opening bell. 1 hour and 13 minutes away. Equity futures positive by just 0.2%. Let's get you some morning calls. First up, Morgan Stanley trimming its price target on Broadcom to 246, highlighting anxiety sparked by DeepSeek and a lack of short-term momentum. That stock bounces back by close to 4%. Your second call from Melius downgrading AMD to hold, citing increasing competition from NVIDIA. That stock is just about unchanged. And finally, JPMorgan reiterating its overweight on that stock, saying AI efficiency gains shown by DeepSeek should drive further innovation. That stock is bouncing back by just 3% this morning. Let's stick with NVIDIA, the chip maker, erasing some of yesterday's losses after Chinese AI startup DeepSeek triggered a $589 billion rout. Stacy Rasgon of Bernstein weighing in on DeepSeek and writing the following: the models look fantastic, but we don't think they are miracles. And the resulting Twitterverse panic over the weekend seems overblown. Stacey joins us now for more. Stacey, welcome to the programme. You addressed my first question in the line before the line I just read, but I want to repeat it and ask it to you, just so our audience can really gauge where you're coming from. Do you believe that this cost around $5 million to build?
Of course it did, and frankly, like it says so right in the papers. So I do think part of the problem with the stock and frankly with the whole space yesterday is that the headlines that kind of emerged from from the circus over the weekend was basically, oh my God, they built OpenAI for $5 million. It's clearly not true. They actually had a cluster. I got to step back. There's actually two models. There's a base model. It's called V3. And then there's a reasoning model called R1, which is the one that everybody's getting angsty over. V3 was trained on a cluster of fairly high-end NVIDIA GPUs. And they clearly had, tens or even potentially hundreds of millions of dollars of work that went into it to work on research and algorithms and everything. And they say right in the note, like, they don't include that. So, and this was just for the V3 model. They took the V3 model and did reinforcement learning and other things on it to develop R1, the reasoning model. They did not actually disclose what they did to train that reasoning model. So actually, I don't know how efficient it was to do that. I do know that the V3 model was very efficient, and there were some reasons for that, the structure of the model and other things. And as I said in the paragraph you just read, the models are all, they're actually really, really good. I don't want to discount that. They're fantastic models. The types of things that they did, though, are not miracles. They're not unknown to the rest of the AI community. And I mean, none of this was secret. I think their implementation was very clever because they're under some constraints due to the export controls. They've got to work very well and very efficiently with what they have. And I think they've got a bunch of really cracked engineers over there. They did a really good job. But I think in general, the whole thing, like the 5 million number and everything else, just caused a complete and total panic, which I do think was overblown. I really do.
And Stacy, we saw that across the board. It goes beyond the chip makers. We saw that from natural gas prices, energy providers. Sure. We saw it from pipeline companies as well. Stacy, there was this line from NVIDIA yesterday that we keep bringing up on this program. We'd love your input on it. They say that it is fully export control compliant. And Stacy, I just wonder how we even know that. How would we know that?
Well, I don't know what they're running on now. The stuff that they trained V3 on is no longer export compliant. They supposedly trained it on a cluster of 2048 H800 chips. H800 it's a derivative of NVIDIA's H100, which is a very, very good chip. It's the exact same compute, slightly lower chip-to-chip bandwidth. Those parts are actually no longer export control illegal. The controls in October of 23 cut that off. I don't know what the new stuff is training. My interpretation of that statement was whatever they're doing, it's running on our stuff, or it can run on our stuff. Right. And this gets to a broader question, by the way, because like the biggest question that people have, there's the near-term questions. Is this going to cause a pause in shipments or orders or whatever? The longer-term question is, do we structurally need fewer GPUs and fewer and less compute in order to do this? And I am not a believer of that. Again, you compute growth, like installed compute in the world's data centers, even before AI was growing in leaps and bounds every year forever. I don't think we can ever have enough compute. People have been spouting it like for the last like all over the place last day or two, but everybody's been talking about Jevons paradox, which is the idea that as costs come down, demand goes up, and demand goes up more than offsets the cost reductions. And remember, I'm a semiconductor guy, right? In semiconductors, costs got cut in half every 2 years for 50 years. It wasn't bad for semiconductors. It was really good. So I am maybe a little biased, but I am not of the opinion that we can ever really have too much compute. And I'm certainly not of the opinion that the compute that we do have was anywhere close to the limit of what we're going to need if AI is going to take on the potential that I think the industry thinks it can. And because of that, I think we actually need efficiency improvements. I think even on the GPU side, your performance has improved by more than 1,000x over the last 10 years, and that keeps going. NVIDIA said they want to improve by another 1,000,000x over the next 10 years. Well, these are the types of efficiency improvements that we need if we're going to get to where I think the industry wants to go.
That said, Stacy, it's going to be a bumpy path. And this is sort of the concern that a lot of people have, that essentially the big tech players that have been spending a significant amount of billions of dollars on GPUs from NVIDIA are going to feel pressured to ratchet that back a bit until they really understand what kind of models they need to really follow. There's a feeling that is the near term that we're going to be looking at. Why do you disagree with that?
Well, look, so the worries about like air pockets and digestions, these are not new worries, right? Those were concerns, the last week and the month before and the year before. So this is not an unknown thing. I actually do think in the near term, the biggest question for NVIDIA like this calendar year is their Blackwell ramp. And I would be shocked if anybody's canceling like Black. What we saw even last week, all this was purchase intentions in general going up, not down. Meta raised their CapEx guide by a massive amount, right? We got the whole, Stargate announcement. Even China announced like a 1 billion yuan, like 140 billion US dollar investment program in AI for the next 5 years. So we're seeing purchase intentions go up. And I'd be shocked if anybody's canceling like their Blackwell orders.
Yeah.
I do think people are going to be wondering what it means for next year as Rubin starts to roll out, and are people going to rethink like their trajectory for Rubin? And again, that was a worry and a concern before. It's not new. We'll probably learn more about that in March. NVIDIA has their GTC event where we'll get more color on Rubin. We'll see partner announcements and all kinds of that. So we'll be able to gauge a little bit more in March. This probably is part of the reason with one of the issues with the stocks in the near term right now is there's going to be more uncertainty, clearly. And the thing is, even if you think that this is not an issue, like it's impossible to prove a negative, right? And so people are going to be free to worry. Like it may sit on the space for a while. Like absolutely, I'm not saying it won't. We'll have to see how things evolve as we go through the year. But I'm still pretty positive long term on the prospects. Is there near to medium term, potential, digestion risk or anything? There always is, but that was true before. I don't think that the idea of that is now like new because
Right.
all of a sudden we've heard of DeepSeek.
Stacey, just quickly here, I am wondering whether this does indicate that China is much further along in some of its technological development and that potentially it could be a real competitor even in the chip space, which we know they're trying to make headway in.
Yeah. Well, see, this is one of the consequences of the export controls. And sometimes people do their best work when they're under constraints, right? And again, it's not like the Chinese are stupid, right? They have fantastic engineers and fantastic talent over there too. And, and you can look at some of the things that they did in this case. Some of the things they did because they were constrained on the hardware that they could run on. They had to make choices that like ordinarily you maybe wouldn't want to do, but if you have no choice, you'll do them. We've seen this in other areas too, like just on process technology. They can't buy tools that can do leading edge. Huawei, however, is making chips on what's called 7 nanometer, which would be a process technology that would be banned. They're making them at SMIC, but they're using techniques to do that which are not going to be cost effective, and like they're things you would not want to do, but if you have no choice, you'll do them. We see the same thing on the semi-cap side. There are local semi-cap players that are gaining share in China because they have no choice, right? They have to buy them, so they will.
Stacy, I could talk to you all day. This was fantastic. Let's do it again soon. Thank you, sir. Stacy Rasgon there of Bernstein. Up next, we'll get you some economic data and some reaction from Lauren Goodwin. The open about 60 minutes away, some economic data, seconds away. Equity futures on the S&P just about positive by 1/3%. On the Nasdaq 100, up by 0.4. In the bond market, yields down across the curve in yesterday's session. Off the back of that risk aversion, the bond market received a bid. This morning, yields a little bit higher, up by 2 basis points on a 10-year 455 as we kick off the Fed's 2-day meeting down in Washington, D.C. With that economic data, let's say good morning to Mike McKee. Good morning, Mike.
Good morning, John. Well, these are the numbers we want to see, but maybe not the month we want to see them. We want to see what impact the president's policies are having on business investment. But this is December data when Joe Biden was still president. Capital goods orders, non-defense ex-air, which is the number that really is a proxy for business spending, up 0.5% during the month after a 0.4 rise in November that had originally been 0.7. Durable goods headlines down 2.2, but that is usually heavily influenced by the Boeing and auto company results that we see. So we'll look at ex-autos, ex-transportation, up 0.3 after a 0.2 decline the month before, and capital goods shipments up 0.6, which would be good news for the GDP numbers in the fourth quarter. But right now, it's the capital goods orders, non-defense ex-aircraft that people care about, and that's up a strong 0.5% during the month. That's more than anticipated. We'll see if that continues into the Trump administration.
Mike, given the constant threat of tariffs, and I'm not sure how you separate the two administrations, given we were aware of the constant threat of tariffs back in December as well, would you expect some front-loading of some orders?
Yeah, you would. And you would think that perhaps people were trying to get some front loading in there. Now, we just got a revision to the capital goods orders. They were up 0.9 in November and 0.5 in December. So it does look like there is some front loading there. A study out from Chicago Booth School this morning suggests that consumers are doing the same thing. They were stocking up ahead of potential tariffs. So we may see a stronger than expected fourth quarter GDP number because people were worried about all of this.
Mike McKee, appreciate it, sir. We'll touch base with you on the Federal Reserve in a few moments' time. It's an intriguing way of doing stimulus, isn't it? The constant threat of tariffs and getting people to spend and front load some of these orders.
Yeah, although it does lose its potency after a while if you keep using it. But that does seem to be what a lot of people were talking about, that essentially retailers in particular were trying to get ahead of any tariffs by stockpiling. Let's just hope they didn't do the same things that they did during the pandemic when they got lots of Lululemon pants and sweatpants and they didn't get
Sounds
other
personal.
ones.
I'm not sure who you're talking about.
It's true. It actually was. Remember the
paper?
retailers? The retailers all had trouble because of the sweatpants.
So like finance pros started buying Lulu as well.
Yeah, well,
they started buying Lulu pants.
They're good pants.
I thought it was Viore is the new thing.
To go with the vest.
Yeah.
You know, the Patagonia thing. Is that still a thing?
Did you see any men wearing leggings?
Too cold for the Midtown uniform. No, they don't wear leggings, Bramo. That's not what I'm suggesting.
It's the vest.
They wear the work
It's
vest.
the Midtown uniform.
Okay.
Yeah.
I know, but that changed.
Okay. Anyway, all right. Let's turn back to the Federal Reserve. They are awake. The two-day meeting has started at 8:30 Eastern Time. Just getting confirmation of that across the Bloomberg terminal. Joining us now to discuss is Lauren Goodwin of New York Life. Lauren, it's good to see you.
Thanks for having me. I like Viore pants for what it's worth.
I'm on board with the Viore movement.
Totally
too.
agree.
I really enjoy
so
them.
soft, so comfy.
So soft, so comfy, great colours too. We can talk about this another time. I don't know if Chairman Powell's into Viore as well. What are you expecting from the Fed chair tomorrow?
Absolutely nothing. In fact, I think it's Chair Powell's express goal heading into this meeting to say as little as possible. The Fed is sitting on a perfect Goldilocks moment, and it's probably not going to last. But if you look at all across the markets, market financial conditions are good. The two-year yield's been sitting right on top of the Fed funds rate. Labor, inflation in pretty good balance. There's nothing they should do other than wait for more information, which includes information about how policy is going to impact their two mandates.
Which speaks to what you said a little bit earlier, which is probably not going to last. What do you think disrupts it?
It's frankly, I don't know. There's just so many things that could disrupt it. If we look at the underlying sort of impulse of the economy, we've seen that the disinflationary process is pretty much intact. In fact, I really hate when this happens, but I agree with Max Kettner, who you had on the program earlier, and with disinflation being, I think, more important for the markets than has maybe been getting attention. You also have the labor market looking pretty strong. There's a lot of runway for the Fed to let growth move back closer to trend without doing a whole lot. But the types of disruptions that we could have are the policy pull forward. We're seeing not only potentially orders being pulled forward, but inflation expectations moving higher. These are the types of disruptions that are just sentiment right now, but as they transition into potentially reality over the next 3-6 months, that's very much in the Fed's timeline.
So do you think that the most underpriced reality is actually that the Fed would be cutting more, not less, even amid a pretty strong growth backdrop?
I don't know that that's the case. Again, the underlying sort of impulse of the economy has been for this gradual disinflation, but inflation is still sticky, and the fact that market rates are still sticky is telling me that investors are very concerned about what that future glide path looks like. And so I take the Fed and the market at its word, where a couple 25 basis point cuts this year is probably a reasonable base case when you're looking at a statement of economic projection that says, look, growth is going to come down a little bit closer to trend, but inflation actually maybe not so much over the course of this year.
So tomorrow when we talk about the Fed meeting, we're going to be talking about inflation, we're going to be talking about rate cuts, but really what everyone's going to want to know is how politically influenced is the Federal Reserve, what's Donald Trump going to be saying, how much is there going to be some sort of shadow Fed later this year that could undermine the Fed chair. How much does that factor into your base case for markets at a time where we know that's all going to happen to some degree or another?
So it doesn't factor into our asset allocation at all, because it's not something that at the end of the day I'm worried about. But I do think that it's going to be very much a part of the conversation, and I think it's an important conversation. The line that the Fed is going to have to walk here, because there is going to be, as we've already seen, this attempt at interference, the line that they're going to have to walk is that we have seen this movie before. We have not only the period in the 70s and 80s, but also the post-war period where we've had double peaks in inflation, and interference in central bank activity was a big part of that double peak in inflation. They've seen that movie before, and they don't want to play into that movie again. That's a message that we've seen Chair Powell iterate in really strong and frankly fun and funny language at press conferences before, but they're going to have to keep doing it. I think it's going to continue to be a part of the conversation.
But didn't he open the door to that himself when in November he said, we don't assume, we don't guess, we don't speculate, and then they assumed, they guessed, they speculated?
It's a really good point. And I think at the end of the day, this just comes down to these are economists, or in Chair Powell's place, not a PhD economist, sitting around looking at data and conditions just the same as all of us, where you don't want to make bold assumptions about policy or about the trajectory of the economy when you don't have good information, but you have to because you're trying to sort of shield the business cycle from that potential interference.
But not everyone on the committee assumed. So then you're left a little bit of uncertainty of trying to understand who is approaching what the economy is doing now, what the economy might do in the future. Isn't that in itself the Fed being uncertain?
It is. And so then from an asset allocation perspective, I think some of the lessons or sort of through lines that we can take from it is that we are dealing with a really quite constructive economic backdrop with a lot of uncertainty. And I think that one of the reasons we've seen such resilience in the markets, including with market-related uncertainty like in the last 24 hours, is because of that economic resilience. And when you're thinking about how then to allocate a portfolio, we can feel pretty confident in areas of the market that haven't been discussed very much over the last couple of days, like credit. If you have a Federal Reserve who is on balance in the process of cutting over the course of this year, even if it's not very much, an economy that's strong, and an impulse actually that's looking quite positive at the moment, that's an environment where we think staying invested is more valuable than not.
It was easy to say that we don't assume, guess and speculate back in November when you didn't have to put out forecasts. Then in December you had to put out forecasts. The very fact they don't have to this time around, it makes this a little bit more easier, doesn't it? Tomorrow afternoon.
They don't have to quantify it, and they don't have to give transparency about who's assuming and really planning to incorporate some of what we've heard so far. That said, there is this feeling that's looming over the Fed, which is that Donald Trump is going to call them up and he's going to tweet at them and he's going to exit them and he's going to basically say, you know, guys, rates have to go down, and then they have to really dovetail this very sensitive kind of historical lesson, maybe at a time of potential transition.
Some commentary from the strategist Donald Trump around 2:35 Eastern would be perfect.
You think so?
In the news conference.
Oh, so excuse me.
Just
Mr.
perfect
Chair.
time. Exactly.
Yes. Yeah,
exactly.
I think he will be truthing live.
Lauren, it's good to see you. Appreciate it.
Me.
Lauren Goodwin there of New York Live. Mike McKee will be in that room in the news conference. Mike, what's on the agenda for Chairman Powell tomorrow?
Well, I think Lauren put her finger on it. He's going to try to say as little as possible, make no news at all. You know there are going to be a question or two on Donald Trump coming. The issue for reporters is how do you ask something when you already know that he's not going to answer? We sort of have to get him on the record saying we don't know what's going to happen, so we're not going to make any assumptions. But right now, we also know that's what he's going to say. So I'm not sure we get a whole lot of clarity there. And as far as what they do going forward, he'll dodge all of that as well, saying we're going to wait and see what happens. So unfortunately for the markets, they're probably not going to get a lot of direction out of this.
Mike McKee, we can only hope. Good luck tomorrow. Michael McKee heading down to Washington for the Federal Reserve's meeting. Look out for that news conference and, of course, special coverage from us that starts at about 1:30 Eastern Time. The decision 30 minutes after that, and the news conference begins 30 minutes later.
I feel like every single person who's coming on is basically saying, don't have to watch it. You can just turn it off. And so I really am curious, if the bar is so low for the Fed chair to basically say nothing, will he embrace that bar, or will he mess up? Basically, will he do nothing, or will he say something that he thinks or feels, and that's going to be a negative?
Matt Diczok can answer that, of Merrill Bank of America Private Bank. Matt, it's good to see you.
Good to see you, John.
How low is the bar for Chairman Powell?
That was a great point Lisa was making. The bar is pretty low. And again, we're not expecting much from the meeting. We're expecting steady as she goes, watch the data. But that does leave the possibility that people do get surprised. Chair Powell had said rates were meaningfully restrictive at the last meeting on December 18th. At that point, the 10-year is in that 4.25 to 4.30 range. We just recently got 55 basis points higher than that. So we thought that was meaningfully restrictive. How does he feel about the 10-year that much higher? So it's always possible he says something that actually makes the market take a dovish implication from that.
Do you believe we are meaningfully restrictive?
I don't think we're meaningfully restrictive. I think the idea of a neutral Fed funds rate divorced from the economic environments doesn't make a lot of sense. Obviously, we have deficits right now about 7% of GDP. The usual deficit is 2 to 3% of GDP. You can't have a deficit 2 to 3 times the normal level and say it's the same restrictive Fed funds rate. So 4% with a 7% deficit is probably a lot closer to neutral. If you had a 2 to 3% deficit, sure, then maybe 2 to 3% Fed funds rate, but it has to be calibrated relative to the economic environment. We think they're restrictive, but meaningfully restrictive, we'd probably fade that a little bit.
At the same time, haven't they been kind of given a pass by the fact that we just saw this rally and concerns about NVIDIA? So, oh yeah, we don't have to really be a problem. Like, we don't have to take a look at the long end that much. And, you know, there's something to see here. Can't they kind of punt on that?
I think if the market volatility continues like what we saw the last day, possibly, but I don't think they're going to look too much into one day, too much into one company. And again, I do think the 10-year is going to be very important for them because the Fed funds rate doesn't affect the economy as much as longer rates. And obviously how they talk about the Fed funds rate, what they expect for the Fed funds rate is what really drives long rates higher. So we believe that they're probably on hold for the rest of this year, but the risk of that would be another cut or two, which is what the market believes.
As a market participant, as someone who actually has to invest, how much do you care about the tit for tat that is inevitable between Donald Trump and Fed Chair Jay Powell?
Well, I think the idea of central bank independence is important. That's been in place for a while. But we have to take a step back. There's nothing new under the sun. And politicians and central banks having different points of view always makes sense. You go back in financial reserve history, obviously there were times that there was a lot of discussions between the central bank and between the administration. LBJ had taken a Fed chair down to Texas, had got very vocal with them, backed him up against the wall, kind of poked him in the chest. So there's definitely times where there is some disagreement, I will say, between Fed chairs and the administration. We believe, as Chair Powell has said, the Fed is independent. They will do what they think makes sense for the economy, and we think that'll be the right way to move forward.
How difficult might it be, though, when you start really hearing more news reports about Trump coalescing his ideas and thinking behind the next Fed chair? We already know some lists, potentially, that he might appoint for 2026, but by mid-year, you might hear more about that one individual, and that person speaks. They're going to probably carry more weight when it comes to the market.
Well, I think the structure of the Fed is set up so they have different governors, different terms, people rolling over at different points. And so it's not that unusual to have a Fed chair change during administration. So we're not overly concerned about that. And again, while Chair Powell is quite important, he's one member of a broad committee. And just changing one chair, we don't think will have a major impact with everyone at the Fed and the entire committee, which all have a very important voice and all have votes.
When it comes to what we saw over the past 24 hours, with basically tech stocks just getting absolutely hammered, $600 billion wiped out for NVIDIA, you still say the U.S. best game in town in terms of growth. Do you still think that U.S. exceptional reigns?
Yes, we do believe, especially in terms of asset allocation and economic growth, the U.S. is the place to be right now. Obviously, we've seen a number of high flyers, particularly in the tech sector, over the last couple of years. If you strip out those valuations from the market, the rest of the best, as we call them, valuations are not extended there. So we're not overly concerned about some of the high flyers not flying so high. We see the market broadening out. We saw it's very too early to call it a trend, but we've seen the equal weight of the S&P start to outperform. And that's kind of our belief. We've tilted more diversified, making sure we have other sectors, not getting too overweight tech, so we don't mind a little volatility there. That's to be expected. And again, it's going to be a chop and grind this year. We don't expect valuations to extend in the equity market. We believe the equity market will follow earnings. Our earnings trajectory is positive. Again, the deficit picture is a big part of that story. And so we're not overly concerned about volatility in some sectors. The rest of the market is appropriately valued, we think, to deliver reasonable equity returns this year.
So 60-40 is sort of back with pretty middling returns.
We've never thought 60-40 was gone. We like 60-40. We do feel better about 60-40 now because it's not that difficult. Don't tell anyone else, but being a fixed income strategist is not that difficult, right? Right now, you look at the ag. You can get 5% on high quality fixed income. That means year in and year out, you're going to get 5%. That's how fixed income really diversifies. Steady, reliable yield year in and year out. But let's look at the risk reward. Let's say we're wrong. The Fed's not only done cutting, let's say they hike, not 1, not 2, not 3, not 4. Let's say they hike 5 times, right? Let's say the curve moves up in parallel fashion. We can all agree that's a pretty conservative assumption. In that instance, on the ag, you'll basically get, over the next year or so, only a negative 2.5% total return. On the flip side, if rates move 125 basis points lower, you're going to earn approximately 13%. The risk reward when yields are higher are so much more favorable for a diversified investor. That was not the case when the 10-year was 1%. The symmetry is pretty much 1 for 1. So we feel this is a good place to extend out your investment cash, to get longer fixed income in terms of duration. We're more favorable in duration now. We're still neutral. We're slightly long. But at these levels, if you got slightly longer here and then added again above 5%, we feel tactically that will work, but you don't have to. You could just be 60-40, you can be strategic. Fixed income will do a very good job of giving you additional returns here.
So what is the one thing that could potentially upend your view?
The major change would be a sustained increase in inflation. Right now, the Fed wants a better labor market. They like the stronger job market. That's not a problem for them. Our belief, and we believe the Fed's consensus belief, is that tariffs are not overall inflationary. They'll lead to a one-time bump upwards in prices, but people change their behavior. I mean, tariff's just a tax. What do you get when you tax something? You get less of it. So consumers will probably adjust. As long as that's the case, we feel we're in the right range. It would take a really sustained increase in inflation to really change the Fed trajectory. And without the Fed purchasing bonds from the government and financing those deficits, we think any major inflationary impulse is quite unlikely.
Hey, Matt, it's good to see you and catch up with you as always. Matt Diczok there of Merrill and Bank of America Private Bank. On fixed income there, as BMO's Ian Lincoln said yesterday, still need to resolve core uncertainties around the policy of the new administration.
Yeah, and the ramifications of them. And with the tariff policy, the idea of Scott Bessent talking about 2.5%, just low grade across the board. Some people think that's actually more inflationary because it wouldn't restrict some of the consumption. It wouldn't increase costs enough to restrict consumption, but it would bump prices up, especially at a time where consumers have gotten kind of used to fungible prices at any given time.
You've got to understand what's happening elsewhere, the tit for tat, what happens with the FX channel. Nothing is obvious about any of this. 2.5 might be seen as a starting point, might be seen as the end point. Again, nothing is obvious about that either.
How many times do I have to say I have no clue this morning?
I don't think anyone does.
Yeah, I know.
I don't think anyone
I think you're
does.
right. I think you're right.
Let's give you an update on stories elsewhere this morning. With your Bloomberg brief, let's cross over to someone who knows everything. Danny Berger. Hey, Danny.
That might be just a slight exaggeration, John. All right, well, Israeli Prime Minister Benjamin Netanyahu is planning to visit Washington next week to meet with President Trump. People familiar say Netanyahu wants to speak to Trump about maintaining the ceasefire in Gaza. Israeli media is reporting that Trump's Middle East envoy, Steve Witkoff, is expected to travel to Israel this week to discuss longer-term solutions to regional conflicts. Billionaire investor Ray Dalio says today's AI frenzy looks like the dot-com surge of the new millennium. The Bridgewater Associates founder telling the FT pricing has got to levels which are high at the same time as there's an interest rate risk, and that combination could prick the bubble. The NASDAQ 100 doubled in 1999 before falling 80% in 2002. The same index has again doubled since the start of 2023. Google Map users in the U.S. will soon notice a change in their app. The Gulf of Mexico will be named to the Gulf of America. The change will take place once official government sources are updated to reflect that order by President Donald Trump last week. The Gulf of Mexico name will remain in use in the Mexican versions of Google Maps, and international users will see both names displayed side by side. And that's your brief, John.
Danny, thanks. Thanks for this morning. Appreciate it. Up next on the programme, we'll set you up for the day ahead, bring you the calendar for the next couple of days. Big 24 hours coming up. Federal Reserve decision tomorrow afternoon. After that, numbers from Microsoft, Meta and Tesla. From New York City, this is Bloomberg. Equity futures barely positive, up 0.1% on the S&P 500. On the Nasdaq, after yesterday's losses, the biggest one-day loss of the year so far on the Nasdaq 100. We're positive by just 0.2%, 36 minutes away from the opening bow. With your morning movers, it's Manus Cranny. Hey, Manus.
Jonathan, and the add back on that NVIDIA story of the $589 billion loss yesterday has dissipated through the morning. At one junction, when we came in and started Bloomberg Brief, it was up 5%. We've given a little bit back. This is about reappraising the margin outlook for NVIDIA. By the way, Pourreza Wealth will be with us this morning. He sold $110 put options. He's bullish on the market. It's overdone. Quick look at the next stock. We've got General Motors. I mean, they've had their numbers, the operating profit. They've had a boost from the US and from China. They're making some pretty brave assumptions. They're saying the first form of guidance for 2025, we're going to earn between 13.7 and 15.7 for this year. But that's not assuming the tariffs are in there. I'll leave you with a look at JetBlue. We have a problem, a supply problem. Capacity constraints, fewer flights, and in the first quarter, a potential loss of between 0.5% to a 3.5% gain. That is way under the estimates. This is about capacity constraint in airlines writ large. Jonathan.
They're having a difficult time, that's for sure. JetBlue down by close to 9%. Manus, thank you. Big 24 hours coming up. Sprinkle of economic data a little bit later on this morning. At 10 a.m. we get the Conference Board Consumer Confidence. Look out for that. Then tomorrow it all starts. 2 p.m. Fed rate decision followed by the news conference at 2:30. Then earnings from Microsoft, Meta, Tesla. Thursday an ECB rate decision plus results from Apple. And then on Friday PCE. Is that enough for you? What are 48 hours coming up?
My question is, what's the most important thing? And I think everyone will agree right now, going into that without knowing any more information, it will be the tech earnings. Very much Apple, Meta, Microsoft. How much do we get a sense of how much they're adjusting their spend out on capital expenditures based on some of the advancements that we've seen?
One thing missing there as well, February 1.
Yeah.
February 1 and
That's
trade.
what I was going to say. On Saturday, there is a potential that we will get tariffs on Canada, Mexico, or China. We might not, but we could. That's basically as soon as it can come.
So the weekend is really a continuation of the trading week, because that could be a big weekend.
We work all the time now.
Are you trying to basically dampen anything?
I don't want 24/7
Hold on a second. Am I just going to say?
No, I'm very against
Are you
that.
going to say, not let's get you to the weekend? Let's get you to February 1st. Well, we'll see what actually happens.
Very against 24/7
Okay, but maybe
markets, all
that's
right.
where we're going to be.
Let's get you to the weekend tomorrow. Julian Emmanuel of Evercore, Lisa Shannon of Morgan Stanley, Nikolai Tangen of Deutsche Bank, look out for that, and a former Kansas City Fed president, Esther George. How many days until the weekend? It's only Tuesday.
It's only Tuesday.
Wow. Monday was brutal, wasn't it? Like a trading week in a single day. A month.
Yes, that's true.
A year. From New York, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.